Now more than ever, innovative technologies are fueling change and sparking new ways of thinking. Collaboration between corporations and startups is key to staying at the forefront of these trends. However, finding the right startups can be expensive, time-consuming, and ineffective. But Plug and Play is here to help. As a corporate partner, you will gain access to a whole ecosystem of innovation. Discover startups that meet your tech interests. Stay updated on the latest trends and network with industry peers. We will help you during every stage of your innovation journey, no matter where you are and where you want to go. Get in touch today.
Good afternoon, ladies and gentlemen, and welcome to Fintech Europe 2022. Now, after an absolutely incredible Fintech Europe Expo 2021, we are back today presenting you the newest from the fintech world. My name is Felix Uhlig, and I will be guiding you through today's agenda. We are streaming live from Frankfurt to Europe and to the world. This is Fintech Europe 2022. We have 5 super interesting panels for you. Open banking, the new mega trend in payment, buy now, pay later, BNPL, digital assets and tokenization, banking infrastructure and core banking, ESG, environmental, social governance and sustainability, and 2 fireside chats about wealth management and technology in times of change for financial institutions. And last but not least, keynotes from Saeed, Seena, Amidi, I'm sorry, we'll hear Saeed as well, and Henning, Zander. But before we start, I'd like to welcome the director of the Plug and Play office here in Frankfurt on stage, Bob Rode. Welcome, Bob.
Thank you, Felix. How's it going?
Great, Bob. Great to have you here. Great to be back in Frankfurt. And
it's great to have you back as well.
Oh, thank you so much. We have an exciting day ahead of us, and you have some opening, words for our audience. Take it away.
Yeah, absolutely. So welcome, everyone, and thanks for tuning in. As Felix just mentioned, we have a really excited yet packed agenda today. So before jumping into the exciting discussions and pitches, I'd like to welcome Seena Amidi, Managing Director at Plug and Play, to talk about our presence and growth in the EMEA region. Seena, please take it away.
Thank you so much, Bob. Thank you for handing it off to me, and thank you for giving me the opportunity to talk about my favorite subject, which is Plug and Play. So, I've already been introduced, but I'm the Managing Director of EMEA. As you heard from Felix, my father and me, we work at a family company. Plug and Play is still a family-run company, and I've been given the honor to run our EMEA region. And I can tell you a little bit more about that in the presentation to come. Currently, we are investing in over 200 companies a year. We work with over 500 corporations. And as you saw in the movie, we can help with the innovation journey from beginning to end. So we invest a lot. We have invested in over 1,600 companies throughout my family's history of investing. This year was a great year for us. We got quite lucky, and luck is definitely part of investing. If anyone tells you otherwise, then they're probably not being true to themselves. But out of our 15 unicorns last year, 5 of them were fintech, including CloudWalk, Blockdamian, Truebill, and a few others you can see on the list. We are proud to say that we work with over 500 corporations, helping them look for startups, helping them work for startups, and helping them be ready to work at the pace of a startup. It's not easy to change from the corporate mentality to the let's do something now mentality of a startup. As we know, startups are a little bit pushy, and we are here in order to make that a little bit easier of a transition. Plug and Play in just EMEA is 200 people strong. We have 200 people here ready to help on anything any of our partners need. And we have 50 people looking for startups just in our region. So constantly creating a database of the best startup. Because it's not just important to find the best startup, but it's also important to compare them to their competitors. Because we need to make an educated decision before we work with any of our startups. Now, to tell you a little bit about Plug and Play's history, well, the Silicon Valley is not the center of the world. No matter what our Californian friends tell us, we had to go to the rest of the world in order to see what's going on in innovation. So in 2016, Plug and Play decided to open up its first European office. Now we have 21 offices in EMEA. We are growing because we believe to get closer to innovation allows us to do more good. So we're in 21 locations with 200 people, constantly looking at ways to make innovation more accessible for our partners and to make life a little bit easier for our startups, because we know that they have a difficult time. Next year, we are planning to open up 9 more locations. This is both based on push and pull, and some of these offices will be fintech focused, like in Helsinki, London, or Oslo, but some of these will be based on energy or based on sustainability in order to help the people of the country. Now, what does that mean for fintech? Currently, this is our landscape for fintech. We have great partners such as Deutsche Bank and Unicredit that have helped us make 16 investments since 2017, and we accelerated over 200 startups just in fintech in Europe. And I'm glad to say that you're going to learn more and see a few of the new startups this year. And thank you so much for your time, and handing it back to Bob. Please take it away, Bob.
Thank you so much, Seena. Now let's jump into the world of fintech. That's what we're here for, right? So last year in 2021, European fintechs have raised over 28 billion in VC funding. That's almost 3 times more than in 2020. We're so lucky to have worked with some of the best fintechs and financial institutions across Europe who have contributed to this amazing statistic. Many of them will be sharing their thoughts with you today, and I hope that you will enjoy this event. And with that, that's enough with me for now. I'll welcome Felix back to the stage.
Thank you very much, Bob. Thank you for your opening words, and well, enjoy the day.
Thank you. Thank you, everyone.
All right. And we will start right off with the first panel of today, called Open Banking, a World of New Opportunities. Now, financial institutions are shifting their focus toward a cohesive, simple, and personalized customer experience. The panel will focus on how banks can take steps to offer innovative customer experience solutions to increase customer engagement and loyalty. And the panel will be hosted by Helen Child, founder of Open Banking Excellence. And she'll be joined by Todd Clyde, CEO of Token, Freddie Kelly, CEO at Credit Kudos, George Parks Davey, Product Director at Klarna, and Claudia Bacena, Head of Buddy Bank at Unicredit. Enjoy. All right, so ladies and gentlemen, the stage is yours.
Hello, and a big warm welcome to our panel discussion on open banking, a new world of opportunity. I am delighted to be joined by 4 industry experts that are absolutely immersed in open banking and are generously going to share their insights with you this afternoon. So let's jump straight in. We've just marked the 4th anniversary of the Payment Service Directive, PSD2 in the UK, and that makes open banking a regulatory requirement. So now is a good time to look at what's next, to look forward, and to look at some market trends. So let's hear from our panel of experts. on the direction of travel in open banking, open finance, and beyond. So, Todd, I would like you to kick off today by just sharing your insights. What are you predicting? What are you hearing? What are you seeing? Open banking. Talk to us about what we can expect to see this year, please.
Good. Well, thank you, Helen, and thank you, other panelists, and thank you, everybody, for joining. So the direction of travel of open banking is up. So yeah, it has been 4 years. I'd say this market has been very slow to develop, and that's because it took a long time for banks to comply with the regulation and actually to produce APIs that were usable. But last year was really an inflection point. We did see two major trends, to answer your question, Helen. So the first was, whereas data had dominated the first couple years of use cases of open banking, last year we really saw the emergence of open banking payments. And that was primarily in the UK because APIs were still stabilizing in Europe. But some of the facts, so there was an over 300% increase in payment volumes November to November. The HMRC reported processing 1.5 billion pounds in open banking payments. There's over 3 million payments every single month happening just to the CMA9 banks, probably over 4 to 5 million in the entire, to all the banks. So I do believe that open banking payments are now really generating the momentum that they need to cross over from an alternative to a mainstream form of payment. So that's the first trend that I saw last year. The second major trend was really improvement in connectivity in Europe. So like I said, last year we saw the takeoff in the UK, but we really saw the APIs become usable and stable in Europe. And the numbers are starting to reflect it. So in Germany, they're now doing 200 million monthly API calls, 150 million in France, 130 million in Italy, 100 million in Spain, 85 in Poland. So what that tells me is, they're all reaching stability, they're all reaching usability, user experience is improving, and volume is following. I feel whereas payments really took off in 2021 in the UK, we're going to see in the rest of Europe, or at least in a half dozen countries, that payments really start to take off in 2022. So that's the direction of travel that I saw last year and continuing into this year.
Thank you, Todd. So payments are going to become mainstream across Europe, as we're seeing in the UK, and you kindly shared a huge amount of data and stats with us. So, Freddie, are you seeing the same thing? Are payments indeed mainstream in the UK? And do you think that's going to happen across Europe? And what else would you add to what Todd has generously shared?
I think it's still early, and as Todd rightly said, it's been open banking generally has been a slow burn. But what I'm quite excited about is looking at from a kind of application perspective rather than a standards development perspective, and looking at other things going on in the market that might drive further adoption of open banking and indeed open finance. And for us, with a particular focus on lending, that's been especially present in the buy now, pay later sector. We've seen a rapid growth, only furthered by lockdown and COVID, of people using more e-commerce products and platforms in general, but also using buy now, pay later as a credit and payment method as a way to increase their flexibility over payment terms, and also has all kinds of different ramifications for the merchants themselves. And what's really interesting as a result of that is it's driven the narrative around should that market be regulated, because it's currently relying on an exemption, which maybe isn't the best route. And we've seen as a result the Uhlig review that the FCA conducted, and also now the subsequent consultation by the Treasury, and the requirements for those products is basically, this is a great solution for customers, but how do we refine the data model, the creditworthiness model, and the payment model to more tightly couple and to better benefit the kind of nature of these products that a much lesser kind of formal credit agreement that happens over a period of time. It's typically around £75 that's borrowed or credited. And it's a perfect use case for open banking, because the regulator wants to see a more stringent look at credit affordability. They want to look at how that impacts an overall real-time view of the customer. And ultimately, it's a payment mechanism. So going back to Todd's point, it's a way that open banking payments at a much lower cost than traditional payment rails can be implemented and benefit the merchant and the customer. So I think there's trends like that, and more broadly, this kind of horizontal integration of financial services that open banking was dreamt up around. How do we actually take away this idea that finance is decoupled from the purpose and bring it back together? And I think buy now, pay later is the first of many trends that are sort of bringing those convenience functions together and saying, actually, I do want to look at it at the checkout. I want it to be really straightforward, and I want it to integrate with all my other financial requirements, which open banking allows us to do.
Interesting that you talked around buy now, pay later and cited that use case. So that's a great, and of £75, which I actually didn't know. So thank you for sharing that. That's a great segue for George, you to jump in and to talk to us about the trends that you're seeing. Obviously, Klarna very firmly associated with buy now, pay later. However, you've got a great open banking story to share as well. So this is your platform to share it with the world. Please, your insights. What are you saying, George?
Thanks, Helen, and thanks for having me on this panel. So yeah, basically coming from a world where there did not exist any PC2, over a decade ago, obviously being a lot driven by account-to-account payments, we have made some observations over the last 3 years into PC2. That open banking has finally arrived at a point where the interest from businesses is that huge, obviously also given the commercials behind this as an alternative way of payments compared to credit cards and others, that we are now seeing a big wave of adding account-to-account payments to the share of the checkout. What we also see is that with the increased share of checkout, we see also an increase in acceptance rate by the everyday customers. I mean, more and more account-to-account payments are conducted than ever before, and the volumes are skyrocketing also due to the fact that of supporting new verticals such as crypto, robo-advisors, stocks, ETFs, and etc. So this is where a lot of account-to-account payments come into play. And this is also this is also probably where it's getting really interesting in terms of trends. I mean, instant payments have been around the discussions for years now. And we're hoping that in 2022, we really would kick off, and following the banks will provide additional support for this at a price where it is also getting interesting for the consumers. Yet the most limiting factor is unavailability and also the consumer fees behind the instant payments. We're also looking at the variable recurring payments, the VRPs in the UK. This is showing a very, very promising trend to provide recurring payment plans with a limited risk on both ends. I mean, the merchant and consumer will definitely benefit from this. So the payment space has a lot of things to offer. We're looking for a bright future, definitely. And we're pretty excited here at Klarna, given the trends and the options at hand, providing the platform to our customers, partners, but also introducing new ways of paying when you use Klarna in the e-commerce.
Wow, so much to unpack there, George. Okay, so I'm curious around payments and using crypto. Is that really a trend that's going to take off? We can come back to it as a panel, but just your comments now, George. Crypto, should I be buying some? Is this, and using it to check out?
Well, I mean, the crypto market is down right now, but no recommendations here. But we do see that account-to-account payments is one way to top up your crypto platforms to get as easy as possible into the crypto space. I mean, previously you had wallets, apps, had to work a lot around tech, but now it's getting so easy. In a favorite way of paying for crypto is now account-to-account payments.
Interesting. We'll touch on that later and see what Todd has to say. Claudia, just to hear from you, if I may, as we travel across Europe. So what are you hearing? What are your trends and predictions for 2022, please?
Well, I do confirm what has been said by the other colleagues. The trend is going on. Obviously, we have to take care of the market we are referring, because, for example, in Italy, we had a very interesting starts when we deployed account aggregation and payment tokenization, both in the Unicredit, but even in body banks, thanks to enthusiastic utilization by, let's say, early adopters. Then after a while, we realized that when all all the early adopters start to use it, then you have to convince the mass market customers that were the majority. And now it came to all the difficulty. So only having account aggregation or payment initiation was not enough. So we have to build a customer journey. We have to build a solution. We have to work in an open banking strategy in order to demonstrate to customer what is the reason behind to aggregate their data, even because we have to take into account that in a market such as the Italian one, people with many current accounts are not the majority of the population. So we are even observing a trend where little by little our customers are having not only one bank as a reference point, but maybe 1, 2, 3 more. So we observe a very enthusiastic, as I said at the beginning, approach, but there is a lot of work in terms of training, education, and engaging our customers. The solution that has been mentioned by the previous speech are the ones that I observe even in the Italian market, probably with a lower adoption rate.
So you talk about a lower adoption rate, Claudia. Is that because you need to do more market education? I'm generally curious.
Well, both sides, in the sense that we have to educate youngers, especially in buddy banks. We have a very young population. They are very technological, so they are very keen to use a new solution, new feature, but often they don't know how to use it, what's the meaning behind, what they can do with that. So we have to build with that trust in order to let them sharing with us all the information and let them understand that we will treat their information as a precious information. So if we collaborate with a third party, we are a guarantee that the collaboration with the third party respect privacy and all their data. But additionally, there is a lot of training in financial education, because unfortunately we still have a lot to do in terms of financial literacy in the Italian market.
That's an interesting point, and a lovely lead into our next question. Obviously, the UK created the blueprint for open banking, so we've got a lot of expertise in the UK, but we've also got a lot of lessons learned to share. So I am very interested now. We've looked at the trends, we've looked at the direction of travel for the market. I'm very interested to look at the next level down. What are we seeing across Europe? What is the current state of play across Europe? Todd, Token have a fabulous presence across Europe. Talk to us about Europe and what you're seeing and what you're doing in Europe. Some of the use cases, please.
Sure. Yeah, and I guess maybe I'll give a quick introduction on Token here. So yeah, we're an open banking payments platform that's trying to drive a shift from the use of cards and wallets to account-to-account payments. We basically provide payments and connectivity infrastructure to large payment providers. And we provide the plumbing for some of the most successful open banking payments propositions in the UK and Europe. So I'll echo what George said a little bit. So account-to-account is definitely starting to rival the cards and wallets. Account-to-account is nothing new. It's existed through direct debit. It's existed through screen scraping. It's existed through what's called OBEPs, like Ideal in the Netherlands. What has changed and is causing an inflection point is two things. So first is the adoption of real-time rails, as George mentioned. It's not just happening in Europe with SEPA Instant, it's happening around the world. And the second is the emergence of APIs, which really, because it's been difficult to access these clearing systems in the flow of commerce. So APIs is what's allowing you to basically now insert settlement over these national clearing systems into traditional consumer to merchant payments or business to business payments. So the use cases, so before the use cases can take off, the user experience has to be good, conversion rates have to be good. And so, we've definitely seen now the APIs improve so that the user experience is extremely intuitive. It's just as simple as logging into your mobile banking. Conversion rates are certainly the same or better than cards. So the use cases that we're seeing, and these are kind of early market use cases, as George said, topping up a wallet, this is really funding this fintech explosion. We all have payments wallets, challenger banks, crypto wallets, FX wallets. They all need to load funds. Another is paying off a credit card. So 1 out of 3 credit cards in the UK, within the issuer's app, you can pay off your credit card using an open banking payment. Paying bills online is a big use case. And we're also seeing it in traditional e-commerce. But those first ones are really the early majorly adopted use cases that we're seeing. And what's exciting about the future is as regulators help the connection to the banks to improve, we're going to be able to do more functionality. So obviously there's a trend here starting in the UK. The European Payments Council is looking into it, and it's called variable recurring payments or automated sweeps. And as those connections improve, the possible use cases improve, and an account-to-account payment will also be able to replace the use of cards and wallets for subscription payments or other card-on-file type of use cases. So I think, obviously lessons learned here, Helen, to answer your question, is those are the early use cases to focus on. The foundation is the API and the user experience and success rates that are in control of the banks through the APIs. And if you build a foundation, the use cases will come. And as Claudia was saying, I find the best way to educate consumers is to let them experience it by actually doing some of these loading of funds and topping up of wallets. And then that helps them to understand just how convenient and smooth this payment method is.
Couldn't agree with you more. Thank you very much, Todd. So, Freddie, Todd talked about an inflection point, a tipping point across Europe. What's your insight? What are you seeing across Europe, and where are we going?
A good question. I mean, there's a lot of kind of nuts and bolts stuff that we've all talked about over the last few years, and there's still, I fear, a great deal more of that to go. We've alluded a little bit to the move to open finance. Todd mentioned VRP and sweeping. We've also got in the UK the Smart Data Initiative convening, I think, today, and everything that goes along with that. You mentioned the Khalifa review as well in our briefing call. There's a lot of impetus, and open banking UK is going through a kind of transition period in terms of governance and ownership, which means that we need to set that up for the right future from this idea that open banking is a kind of piece of regulation that we comply with to actually it's a commercial opportunity for everyone involved, and how do we extend it and iterate on all these things. But going back to what I said before, I'm really excited about the kind of the consumer applications and the kind of level 2, level 3 consumer applications. In the outset, everyone was quite hung up on like PFM and combining accounts and things like that. But I quite like the idea of sort of this invisible wiring that goes between service providers that starts to make sense for customers in a way that's non-intrusive. And that's why I think, to a degree, the buy now, pay later, in a sense, is kind of a first sort of step of that, removing this sort of unnecessary decoupling. But you've seen also things like Monzo experimenting with like if this then that style triggers, where if my pay is X, maybe I can contribute Y more to my pension, and if I have Z left over, I can put that into a savings account with sweeping, for example. There's all this kind of magic that's yet to be unlocked with the gluing together of all these different technical standards, and it becomes much more real and much less dry when you sort of take it off the page and build these things. And for us, we're really focused on credit throughout the life cycle and where open banking touches that. So we've looked a little bit at applications. How do you judge risk for a kind of new consumer that doesn't necessarily interact with credit in the same way, and credit itself doesn't play in the same way? And we work with companies like Curve, who for example, have led on this sort of flex type product where a past payment can be converted into a kind of credit style arrangement or 0% credit style arrangement retrospectively in a way that consumers are, totally transparent to them, and they can just, press a button and it works. And there's kind of extensions of that past the application stage of credit into, how do we collect repayments? Do repayments always need to be on the same date and time and amount, or could we use the AIS combined with the PIS to say, well, actually, Freddie's cash flow is variable, and it's going to make sense to make this payment for this amount at this point, and then this payment for a different amount at another point, and completely automate that. And all those kinds of, I think, sort of level 2, if you like, use cases are just starting to hit the market, and they're super exciting, I think.
Super exciting indeed. And I like your expression, unlocking the magic. I might coin that one if I may. I saw George nodding as you were talking. Do you want to come back to AIS, Freddie? So hold that thought. George, you were nodding to what Freddie was saying. Do you want to add on that and share with our audience more of what you're seeing across Europe? I mean, you're based in Germany. You've got a huge insight to share. Go for it.
Yes, but maybe I want to real quick take it back to Todd on the PIS side. I mean, we all know in the UK with the open banking IE and the payments flow, they have a beautiful experience. We got app tap redirection. It's very seamlessly integrated into the e-commerce flow in apps and so on. I think especially in Southern Europe, what we've seen, there's still some need for enhancing the consumer experience. We've seen multiple redirects. We've seen obstacles, unnecessary steps in the way. And also what we have noticed lately with the increase, as Todd also mentioned, we've seen millions of account-to-account payments rising in the last year. We've seen a lot of payment errors, payments failing due to the banks basically restricting us to conduct payments. So I think we did a good progress, but there's still a long way to go. When you think about IBAN discrimination in France, not being able to send money across borders, we've seen in Spain and Italy, banks denying payments with a higher volume payments due to fraud detection inside the bank, but telling us the payment has successfully been conducted. So I think we still see some work need to be done there. But on what Freddie said, I mean, on the AIS, I can recall his examples. I mean, we also see this with our customers, that they're providing lending options, flexibility in payments. When do we pay? We see the spending curves, the expenditure rates of the customers. We can really tailor the payment experience also for late payments towards the customer's needs. So this is like a big trend that we're seeing here also with our partners to really make the life of the consumer as easy as possible.
Okay, hold that thought on AIS. I just really want to hear from Claudia now. George talked about some of the challenges we're having across Europe and mentioned, he cited Italy. Do you want to expand on that, please, and also share, some of the trends that you're seeing in Italy as well?
Yeah, the trend of open banking, so collaboration between big banks such as the ones that I represent today and the fintech environment are growing and growing. I just can mention an example for Buddy Banks. We launched last summer a partnership for investment and insurance. It was a project that we can deliver in 6 months, very fast, with low budget, with low capacity. So in the past, that would be impossible. What we experienced that is not only that there is a plenty of opportunity, but there is a lot to invest internally. So I do confirm that sometimes there are friction between fintech and the banks, not because the banks want to forbid some payments or some, let's say, call, but because inside of the bank, we have to build the knowledge regarding this world, because nowadays often people from marketing, people from digital channel, people from the IT knows everything. Maybe many of them are here listening to us, but then there is a huge plenty of colleagues, risk management, legal, compliance, operation, security. They are doing something else. So probably they don't know all the aspect, what is behind a real open banking strategy. So there is a huge to do in terms of training of our internal people in order to, let's say, increase the awareness in every single employee of a bank regarding this opportunity. And then it will be easier to interact with fintechs whenever. And what has been mentioned by George, cases where payment were forbidden will not happen anymore, because we will have a common language, we will understand, and everything will be easier for both of us.
Claudia, you've got a challenge on your hand to educate everybody on open banking. All power to you on that one, and maybe we can help you there, include you more in our community conversation. It would be an absolute pleasure. And whenever I can, I like to pass the mic to a female. So Claudia, you've got a speaking slot whenever you want. Okay, Freddie, we've talked about at a high level, trends for the industry, trends across Europe. And you mentioned AIS. We are an industry that loves its jargon. Okay, AIS. Let's start by unpacking it. What is it? Okay, so I'm going to ask you to explain what it is, and then let's look a little deeper into it and look about how it improves the customer journey. So, Freddie, please enlighten us. AIS. What does it really mean?
Sure. So as Todd mentioned at the beginning, AIS was kind of where we started with the UK open banking implementation. AIS stands for Account Information Services. I like to think of AIS and PIS as read and write. So AIS is reading data out of an individual's account and doing something with that data, and PIS is transacting, so writing, so making payments. And really they're technologies, and we spend way too much time talking about them and not enough time talking about what they can actually do for customers. So for us, AIS is an input to an existing problem, which is measuring the risk of a customer. So when you're sort of dealing with purely online interactions, it's a high trust environment, and you need to understand who someone is, and whether they're going to fulfill on the obligations of a credit agreement. And as I alluded to before, this is something that's being reflected on at the moment with buy now, pay later, because that the cadence of these relationships is much lower, and you're having much more traffic, and some of the traditional rules and regulation around it perhaps don't make the most sense. But essentially, you need to know if Joe Bloggs is going to repay a loan, and the traditional ways of doing this rely very much on Joe Bloggs having taken out previous loans, and you being able to track that information and use that as a barometer. And what we find increasingly is that people don't interact with credit in the same way. They perhaps don't even use it at all. They also don't stay in the same place, and so tracking their individual data is much harder. And open banking gives us a way to input into this problem and say, well, actually, if we want to measure someone's financial health, and crucially their vulnerability, which is so important for consumer credit, we can use open banking data as an input, and we can model based on performance and history that we've collected from other customers, what that means from a risk perspective. And that's kind of what I like to think of, and maybe I'm bigging myself up, as sort of like a level 2 application, where level 1 is like, we take the data and we play it back to you in a way that's useful. And I think there are, as I alluded to before, really interesting applications where you start to stitch AIS together with other technology. So maybe other data sets or payments or combinations of. So I mentioned this little sort of idea of like glue logic before, but can you take, the data from your account and automatically import it into, your tax documentation? Or can you use that to, alongside something like sweeping to make sensible investment decisions automatically, without you having to think about it, so your money's always working? There's a load of value add that comes from being able to read data that isn't just about me getting a better method of looking at a bank statement. And I think that's something that we need to remember and think about when we position this to customers, because they don't really care what AIS or PSD2 or RTS and all these things mean. They just want to know how it helps them.
I couldn't agree with you more. And I see Todd smiling. So Todd, please comment on that. It's all about the use case. AIS use cases, do you want to share and inspire our audience with some of yours, please?
I'm going to steal Freddie's word, level 2 use cases. So level 1 use cases was your standalone data use cases, personal financial management, credit scoring for loan applications. Level 2 is combining data with the payment or with other actions. So we see an AIS call or access to data about the user being used to onboard a customer to these applications or these wallets before you fund the wallet. We also see it being used for customer insight at the point of purchase. So, imagine seeing my purchase history, doing challenger or champion offers, or ensuring affordability. The perfect example is if I were an online gamer, I on board with a data call, I do an affordability check with the data call, I load my wallet with a payment transfer. So certainly we're seeing a combination of the two to create level 2 types of use cases.
Okay, thank you. So George, in your previous answer, you talked about AIS and how it improved the customer journey. So can you quickly give us some more insight into that before we move on, please?
Yes, delighted to. With the AIS, we have seen big growth in the past year. The AIS is so much more versatile than the payments around open banking. Yet we kind of have the feeling that due to the massive rise of PLS, it didn't get really its credit for it. So we are basically seeing dozens of use cases where the data is provided through the banks is being used for in such a granular way that it perfectly fits into our partner's mission. A typical example, and one of the most easiest way using AIS is you can do an account verification for onboarding to pay in, payout accounts, or for direct debit. This is also our preferred way in Klarna, actually, to enhance first of all, the user experience, to not having our customers remember the IBAN of Fahd or any account details. So we are taking the approach of providing a risk mitigated account data verified payment source. But one thing also connecting AIS with the buy now, pay later space, as you probably know, Klarna is kind of big on this. Looking at account information for buy now and pay later, this is heavily related around credit scoring and for the underwriting processes, where you can make use of the data and creating a real-time snapshot around the financial well-being of a consumer in a financial situation. And what we see here lately is that this is also now finally moving into the B2B space. So this is where it's becoming really, really interesting. And I think that's where we do expect some kind of a small revolution here. Often SMEs have to deal with cumbersome payment options and old billing, bookkeeping infrastructure, as well as the everyday struggle on the liquidity, especially around peak seasons like Black Friday, or when scaling up the business from one day to the next. So I think with the buy now, pay later space and account insights is kind of conquering the B2B space, we will see much more flexibility for businesses and also for a new modern way of shaping your own payment cycle with credit installments and other payment options. I mean, this is something super exciting. We're also seeing with our partners and looking into in Klarna.
It is super exciting, and we are covering quite a lot of ground and at a lot of depth. But I would like to move on to Claudia. So George talked about a revolution that's happening, and you've got some insight. I'd love you just to take some time now to talk about open banking helping financial services keep pace with that change. I'd love you to talk about that, and then want to wrap up talking about the Khalifa report. So how is open banking helping your financial service providers keep pace with that change that we're all talking about, please?
Well, we realized that, for example, when we released the account aggregation solution, that, as I said previously, the awareness of our customer, thanks to personal financial management tools that we have embedded in the app, increased because they were aware regarding the overall portfolio, overall assets and liability that they have. Additionally, we learn a lot in terms of CRM, because in the past, we used to address some customer thinking that they will keen on buying some products. Thanks to the account aggregation, we realized that product was not good for him. For example, we realized that he already has a mortgage with another bank, so it was not useful to engage on mortgage, and we start talking something else. So meaning increasing sales on the right product to the right person. Third, really deeply increase the ability, the speed up of to deliver a new project. So we embrace it, especially with Buddy Bank being, let's say, a startup, collaborating with external partner, make it's very fast, easy to test, easy to assess, easy to integrate. So this is a really important, let's say, innovation that all this environment brought to us. We have even now many speech on the floor talking with many fintech that we want to integrate, and I think it will be easier even to test, understand if the customer loves something, and then either continues or change the way. But then you have the possibility to fail that in the past was not something that you can bear according to the cost behind a new product.
Claudia, we could talk all day around open banking and the direction of travel. Sadly, we're coming to an end, so I just want to wrap up with one final question, if I may. We're coming up to the 1-year anniversary. At the top of this panel session, we talked about it 4 years since PSD2, but it's 1 year since an absolute monumental report, the Khalifa report. So what's needed next in the market? So let's sort of bring it all back. So I'd like to ask Freddie and Todd on this one, because what's needed next in the market to drive us forward to open finance? Freddie, the Khalifa report, and if we can make it really sharp because we're up against the clock, what's needed next, please?
Coordination, I think. The recommendations in the Khalifa review, to an extent, are being carried through, especially with it relating to smart data. But I think the home of open banking as being this custodian of all this knowledge we've accrued on doing this for for the banking sector now needs to be reused for other industries, and we need an appropriate funding and governance mechanism, which is obviously in discussion to do that.
Coordination, key word. Todd, maybe you'd like to give a key word and then an explanation. What would you say? What's needed next according to the CLEFA report in your insight, please?
Well, overall in open banking, so I agree with George that, SEPA Instant needs to come down in price, be ubiquitous. APIs need to continue to improve. IBAN discrimination needs to be eliminated. So there's a lot of just foundational stuff. But in the CLEFA report specifically, so there was supposed to be easier access to capital, easier access to talent. I see improvement in those areas. The other one was helping to overcome the barriers created by Brexit to make it easier for UK companies to passport and grow internationally. So I'd say we haven't seen a lot of improvement there. In fact, being a UK institution could actually be detrimental to your success in the EU. But look, I think we've all found ways to work around that.
We have indeed. And that's probably a great way to wrap up. I mean, open banking, open finance is founded by pioneers, entrepreneurs, and we always find ways around a problem and to create that innovation, those moments of magic that Freddie talked about. We are at the end of our panel session and it has just flown by. We could have talked for another half an hour. So I would like to say thank you very much to Freddie, to Claudia, to George and to Todd. You can chat to us over in Hopin. But again, thank you very much for keeping us company. I hope you have enjoyed it as much as I have. Thank you. Bye for now.
Thank you all. Thank you, Helen.
All right. Thank you very much, everybody. Thank you to all the participants. And of course, thank you to Helen for hosting the panel. And Helen just mentioned it. You can now join the participants for a quick Q&A over in the speakers lounge. If you're joining us on Hopin, this will be on the left-hand side. Just click on the Expo symbol and you're in the Q&A. And we'll take a short break of just about 5 minutes. And in the meantime, you can feel free to use our chat to actually let us know where you are. Now, if you're joining us on YouTube, use the YouTube chat. If you're joining us on LinkedIn, use the LinkedIn chat. Wherever you're watching us, type in the city where you're from or maybe just a country, and we'll get back to that and do a little, worldwide wrap up after the break. We'll be back in just about 5 minutes. See you then. Welcome back from the break, everybody. I hope enjoyed your, well, cup of coffee or cup of tea. And let's get to where you're actually watching us from. We have someone here from Frankfurt. We have Ben from Israel. Hi to Israel. We have Brazil. We have Malta. We have Amsterdam. We have Mainz. We have Amsterdam again. London, Moscow. We have Brazil. Hi to Brazil. Probably early morning over there. Milano, Antwerp, Belgium, Ashgabat, Turkmenistan. Oh, wow, Nigeria, Kuwait, and wow, amazing. Now, welcome back to the next session here at the Fintech Europe 2022, and welcome to our next keynote from the head of the startup program at Aareal Bank AG, Henning. Zander. Well, Aareal is a long-standing partner of Plug and Play in Frankfurt, and Henning heads the startup program at Aareal Bank AG and is responsible for the 4 pillars of cooperation with startups across the group: the accelerator programs, collaborations, strategic investments, and own startups. And he's also chairman of the Investor Advisory Board and observer on the investment committee of the first Pan-European Venture Capital Fund, PropTech One Ventures. Welcome, Henning. All right, Henning, stage is yours.
Yeah, hi. Thanks for having me. Question is how and why interact with fintechs, and this is a title of my keynote. And as you all are aware, the world obviously is changing. And if science came out of the pandemic winner, then technology certainly was a close second. Because without computers and connectivity, the lockdowns could have ground most economic activity to halt. And the future of work, of course, will be hybrid with in-person and remote aspects. And while telework obviously has been around for decades, it took a transformative event like the COVID-19 pandemic to force the paradigm shift. And let's have a look at 2030, and life will be vastly different in 8 years from now. The world population is expected to be around 8.5 billion in 2030, where India will overtake China as the most populous country on earth. And interesting fact, the fastest growing demographic will be the elderly, and there will be more grandparents than grandchildren in 2030. And as well, there will be other challenges like an increase of 35% in food demand, and around 40% of the US jobs will probably be computerized. And last but not least, there will be hundreds of billion connected devices by 2030. And it was in 1965 when Gordon Moore made a prediction that would set the pace for the modern digital revolution. From his careful observation of an emerging trend, Moore extrapolated that the computing would dramatically increase in power and dramatically decrease in relative cost, and that at an exponential pace. And this insight, which is known as Moore's Law, became the golden rule for the electronics industry and a springboard for innovation. And this increased velocity to change seems to be the norm in our modern era. In fact, we've come to expect it of our technology. So there's no time to rest, but great opportunity to create a brighter and better future. And for years, society has been adopting new technologies at a faster and faster pace. And at the same time, a fundamental shift in capabilities has intensified the disruptive impact of these technologies, accelerating the rate of change. So data storage, for instance, their costs have plummeted over the past few decades, and cloud computing has exploded and leveled the competitive playing field, giving startups access to the same computing power as the largest corporations in the world. And at the same time, machine learning and emerging technologies such as augmented or virtual reality are rapidly transforming industries. And disruption is the new normal, and failing to recognize its inevitably and the potential impact is certainly a mistake no business or a business leader can afford to make. If you're still not convinced, hey, data never sleeps. In this famous infographic, we can have a glimpse of how much data is created every digital minute in our increasingly digital-driven world. In our everyday life, not much may happen in a minute, but on the internet, you're just some of the key figures of what happens in 1 minute. For instance, customers spent $280,000 on Amazon, or 12 million people sent an iMessage. Microsoft Teams or other tools like this connect more than 100,000 users every minute. And this is because today there are around 5 billion internet users across the globe. So the question really is to most of us working in established corporations, can you disrupt yourself and grow, or will you be disrupted? Because only 12% of the Fortune 500 companies who were in business 50, 60 years ago are still around. And experts agree that roughly 40% of today's businesses, unfortunately, will not exist in a meaningful way in 10 years. But what is often overlooked is that innovation takes many forms, and it isn't always disruptive. So, hold on. Just because you don't break and remake markets, it doesn't mean you're not innovative. The quest to, let's say, completely break and rebuild often even leads to failure. And I guess innovation doesn't look like disruption always, but sometimes it's a silent hero that's giving us a new and better way to do things without us even realizing it. And hold on. Okay. You probably are familiar with the traditional innovation model, which is limited to your firm boundaries. And companies engaged in this close innovation, they carry out work in a self-contained innovative environment. So the place of innovation is always within the company, and opening to the outside is therefore almost impossible, and innovations are only developed within clearly defined company boundaries. So you have your think tanks, design teams, hackathons, and so on. And of course, R&D, but know-how, technology, processes, and all the intellectual property remain under the control of this company. Whereas, and this is, I guess, what most people should look at, if you choose for an open innovation model, you can cross these boundaries and add the additional valuable input from outside your organizations, and you can rely on external knowledge sources for innovation management strategies. So this means basically that sharing knowledge and information about problems and looking to people outside the business for solutions and suggestions. So you can, for instance, tap PhD candidates, scientists from all over the world. You can interact with startups and get their input to get additional sources of knowledge for your innovation processes. And that's one reason why we, for instance, also cooperate with startups, because they bring a different perspective and also take a different approach to this work process. And I think it all is summed up very nicely in this African proverb: if you want to go fast, go alone. If you want to go far, then go together. Because after all, often ideas are generated when we are alone, but they really germinate when we are together. So how can you interact with startups? And it was already mentioned that we have 4 different ways to cooperate with fintechs at Aareal Bank, and I want to quickly introduce you to this We want to find the best startups worldwide that match us and our questions. And this was reason enough for us to start also working with Plug and Play in 2018 when the program was launched here in Frankfurt. And in order to better understand what drivers of digital developments are and to keep an eye on also important trends, we have been increasingly relying on collaborations, which is the second pillar of our program. And in this way, we can accelerate innovation in our own company and for our customers in the real estate industry. We have also invested in startups, for instance, in the venture capital fund in 2019. And on top of that, we have both acquired and invested in a couple of startups in Germany and other European countries. And lastly, to validate some own business concepts in the market, we also established a separate structure called Amplon Ventures, which pursues the objective of founding new ventures and to enter into partnerships with ambitious founders. I think it's worth noting that none of this obviously is mandatory, and you don't have to master this whole keyboard. But in contrast, I think every corporation should ask, and this is my recommendation, what where do I really want to play, and what's my digital strategy? And of course, to find the best startups, you need a multi-level selection process, and you always should, I think, start asking yourself which cooperation partner suits me. And in order to answer this, it's first worth taking a look at your own expectations, but also at your competencies. So, for instance, what can we do best, and where do we need digital support, and how can we use the innovation potential from other partners? And obviously, you have to kiss a lot of frogs before you find your prince, and this also applies, of course, to Aareal Bank. And maybe I can pick out just one or two examples what we have achieved in the past in all our business areas. Apart from the investments, we have, for instance, looked at, of course, sustainability topics, and they play an important role in our company as well. And together with this startup, we have attempted to calculate climate value at risk for a section of our credit portfolio, and determine the extent to which our financing is consistent with the goal of limiting global warming to a maximum of 2 or 1.5 degrees. And maybe towards the end of my speech, who's behind this? And I want to point out that we want to work with all interest areas of our bank, and this is only I can recommend to you as well. In doing so, we search for pain points together, and we do this with a diverse team. And then we go and search for the best startups. And our team consists of colleagues, and this is, I think, an advice I would like to share, who all work only partially in the startup team and otherwise perform other tasks, for instance, strategy development or development of digital products or sales even. And in order to pass on these valuable insights gained from working with startups to as many positions in the bank as possible, these colleagues rotate completely back into their teams after 1 or 2 years. And to sum it all up, if you want to create your modern love story of David with Goliath, I think, yeah, I can only hope you are on this journey already. And I think there's no single one form of cooperation with startups, because as dynamically and lively as the scene is, there are also many opportunities for companies to develop individual cooperation and participating models. Thank you very much.
And Henning, I guess you will be available for Q&A as well. So if you have any questions for Henning, please join him in the speaker's lounge. If you're joining us on Hopin, it's on the left-hand side, and there you can ask him questions if you may have any. And now we will continue with our fireside chat, exploring the impact of fintechs on wealth management. Now, the pandemic has had a big impact on how the financial service sector operates, but wealth management in particular. Wealth management services were and are very much based on personal relationships. However, amid the pandemic, the industry is evolving and more fintechs are moving into this space. We will hear the founder and CEO of ABAKA, Fahd Rachidy. Fahd is a serial entrepreneur passionate about helping the industry create secure financial futures for everyone and reinventing the way the financial industry works using artificial intelligence. Fahd was previously co-founder of scientificbeta.com, the leading index digital platform recently acquired by the Singapore Stock Exchange for $205 million. And we'll hear Henrik Herr. He is CEO of Rothschild and Co. Vermögensverwaltung Deutschland. Henrik started his career at Deutsche Bank and then moved to Credit Suisse, where he stayed for 18 years. That's a long amount of time. And from 2016 onwards, he was responsible for Credit Suisse's wealth management business for Germany and Austria. He was also a member of the supervisory board of Credit Suisse Germany for 4 years. And in autumn 2020, Henrik joined Rothschild and Co. as CEO of Vermögensverwaltung Deutschland. So welcome, Fahd and Henrik, and enjoy the fireside talk.
Thank you. How was the coffee, Henrik?
Yeah. There was a little bit pressure. I'm not so good on technical stuff. That's why it's not good to be the problem. But I hope you are doing better, Fahd.
I'm okay. As a tech entrepreneur, I can't complain. But I think it's a good story because we see that we've been preparing, rehearsing, using that platform, etc. And actually, on the day when you go in production, there's always glitches that you were not expecting. So what's your experience in the industry actually of that transition going to, looking at the technologies, ensuring that everything is running smoothly, building the solution, and then ready for delivery. And then when the times come, there's always unexpected things happening.
Yeah. So you would be surprised if I had no technical problems, in other words. Cool. But it's nice to be with you in the fireside chat. And congrats to your great exit. That's fantastic.
Oh, thanks. Yeah, that's a while ago now. And, I think we are with ABAKA, we're having an exciting time. And I think on the introduction, we mentioned the need, especially in wealth management, to create personal relationship with clients. So, I guess it could be a good starting point on our conversation and looking at what you guys are doing and how do you take that approach of building that personalization, both directly with your customers, but also with the relationship manager and the bankers.
Absolutely. I think timing-wise, it's very interesting. There are some days when I feel like a dinosaur. Because I'm doing this now for 30 years, and the key in the center is clear, it's a client relationship, but all the environment around is changing dramatically. And in terms of fintech, in really gaining more influence or discovering the opportunities in wealth management, I would say there is still so much opportunity and opportunities to improve that. That's why it's great to learn from you. And also share my view on things.
Right. Yeah. No, I think it's actually an exciting time, especially in the wealth management. We see actually really a pickup and an acceleration of demand from clients we're working with, for example, HSBC or the likes of Prudential and so on and so forth, specifically in wealth management, where on one hand you have, to address the challenge of customer expectations, right? We live in the 21st century. They have very high digital expectations, and historically the financial industry was probably not as advanced as in other industry as providing that digital experience. What's your thoughts on that, and specifically your experience at Rothschild?
Yeah, it's interesting because I see myself as a person who's interested in learning and interested in technology, but the key, as I said, in wealth management is having relationships, and technique and digitalization should support processes, make lives easier, and help to make better decisions. What I explored for many years that innovation very often came, as I worked for larger institutions, via IT department or operation. And this was always very difficult for these people to reach out to front guys like me. And it was very difficult to align there. And now in a smaller organization, especially if you run it as a CEO, you can really try to look for partners who help. And it's not only the final investment decision, it's not a reporting. There are a lot of topics which you cover, from starting to collect intelligent data, to help give convenience on the process, and to have a unique client experience. And I would say there is a lot of opportunities. And from my perspective, and most of the organization look for partners, look for white labeling solution instead of trying to solve it out by themselves. So I know that definitely many of the stuff I see in front of us, we need partners.
Yeah, no, it's very important. I think the previous discussion also highlighted the benefits of partnering between fintech that can be more agile and have great technology, but maybe lacks or are facing some specific challenge relevant to small businesses. That is larger organization, the dinosaur, as you said, where it's complex. There are many issues to address. So our experience there, and it's exciting also that you touched upon data. In our space and in the world where people are producing a mind-blowing amount of data online, while at the same time you now have a set of regulation with regard to data privacy, but also specifically probably in wealth management, where it's even probably a stronger requirement to a certain extent, to maintain that client privacy and secrecy. So how are you able, or how do you see actually the delivery of that personalization and that personal digital experience with this context, within that context?
Yeah. So of course, and this very clearly, we have so much regulations in our sector, and for me, it's always a question: whom do you want to protect and how? So I have the question: if I look at the German market, you have all the regulations, and most of that has a clear historical background, but it's a retail background, and they have to protect people who can't afford to lose money, which I completely understand. On the other side, if you're talking about wealth management and if you talk wealthy people, they very often have complex wealth. And this is not only their portfolios with Rothschild or whomever, it's companies they invest in, it's real estate. They are for interdependent. They want to understand and they want to have a partner with transparency. And then they have strategic discussion on a holistic base, but for that you need the data. Otherwise, it's a very isolated view, and that's why I think you have to improve there if you want to have material discussions. Is this fine with you? Do you share this view?
No, I support your view totally. And we started our journey with building that personalization through capturing data, analyzing customer data, and then leveraging our machine learning model to be able to build personas, identify what is the next best action or the product that could be relevant to which client and when. And then actually what we see is it's really accelerating in the wealth management space, but in a different framework, to the extent that actually you want to build that knowledge, that customer intelligence, but for the benefit of advisors, and help them and basically enable them to engage each individual, each of their customers at scale, empowering them with insights, and enabling them to increase their reach. So how do you see this work around data and AI empowering advisors and relationship managers?
I think in reality there is still a large gap. So if you see the old world, what I would say, I'm working in the old world. It starts that you collect the data in an analog way. You collect the data via paper and ask questions. And these questions and many formulas you go through are motivated with a risk background. But it's a question, if you really want to have an interesting, intelligent solution which provides is this the right kind of question, or is it just the duty you have to do? So the first step is then collecting analog data. The second is, what are you doing in terms of GDPR, for instance? We have created this solution, and then the people are scared to collect data because they know what they risk if they collect too much data. And for me, in running a bank, it's very important to have a partner who help me through this, because then if you're personally reliable as a CEO, I'm not a data collecting expert. And if I talk with lawyers, they come with, what if, Henrik? And then it's very difficult to go the next step. And for me, to increase the final solution for the clients, I have to start collecting the data in a different way, and then have a data strategy, which I would assume many of the dinosaurs are missing, which is an opportunity for the fintechs, I would guess.
No, yeah, it is to some extent, and I have to say that on our contract with our clients, we see the schedule on data privacy increasing all the time, and adding some, as you said, the lawyers, what if, adding some lines there. Yeah, that's challenging, but it's part of what we owe to customers with regard to their privacy and also being compliant with those regulations. In fact, we see it as a benefit because it basically, I think, it provides more clarity and more transparency, both for banks as well as consumers, on what we can do, what we cannot do with regard to using the data, etc. Right?
Fahd, may I ask you, what kind of data is helpful? What do you think? What are data as the most value for the clients later on in the process? Where do you focus on?
No, it's a great question actually, because usually our clients will have some basic data, so your name, last name, date of birth, etc. And then they will have also collected the history of purchasing transactions or your main, But if you're interested of, do you want to understand amongst your clients who's actually keen to invest in ESG investment, for example, or who has an appetite to invest in bond versus equities, etc. What are their preferences? And what type of investors they are? What are their behavioral traits?
The why question. No?
Yes, and then so those are the kind of data that on our platform we are aiming at identifying, collecting, and our machine learning model will basically build subsequently those personas, build those insights relevant and align to the personality traits or the risk appetite or the preferences of the investor, of the clients. And it comes from a broad range. There are many ways that you can acquire external data on individuals. Of course, it's all with what we've said previously with respect of their privacy and with their consent and in compliance with GDPR. But you do have the ability to capture social media profile, to capture open banking data, to capture health data, device data, telemetry data on that device, web browsing history, etc. So there are external sources of data that can be leveraged, and through which actually you can really dramatically enhance the intelligence, the insights that you're building on the investors, on your clients, basically.
Yeah. And do you also use predictive data, or is this too early?
So we are looking at existing data. The machine learning model are actually a sort of a recommendation engine, so able to predict or identify what is likely to be of interest for that specific individual, whether it is a product recommendation or an action on their portfolio or talking to their advisors, etc. So in that way, that's predictive. But not really on predicting the data there.
Okay, cool. Yeah. What would your advice to me in running a bank in Germany?
Right. So, well,
You're
I think
not effective. That's clear. But I asked for the question.
Well, it obviously depends on the business strategy and your own vision for the bank. But I think there are key elements that we see developing in the industry, which are challenging for organizations like yours. And obviously, one is the fact that basically today, you're competing in a world where you have the N26 Revolut of this world, as well as actually a big tech providers entering the financial service industry, and so there is a level of expectation here from your clients. There is a lot more competition in terms of enabling clients to have access to a marketplace or an ecosystem where they can pretty much find any financial product they like within the same provider, right? And so it's really being able to address that demand and move at pace, obviously. Otherwise, what we see is that it's actually quite relevant in wealth management, also in insurance, that the distribution channel, your distribution channel, are being disrupted by those guys.
Disintermediation, you're talking about.
Disintermediation, exactly. So you're basically kind of losing in the long term the customer relationship, if not the customer himself or herself. And so it's key actually to ensure that you capture that relationship, but also you're in the phase where you have a huge wealth generation transfer, so you're also going forward going to have to address a different target audience that used to be your customer for the past 20 years, and it goes into the same line.
Thank you. Cool.
Yeah, it looks like we're closing here and getting close to the end, so it was great talking to you, Henrik. Thanks.
Thank you very much. Appreciate your time, Fahd.
All right, thank you very much, gentlemen. I am really glad everything finally worked out with the microphone. Thank you for joining us. And I think you will be available for a short Q&A in the section on the left-hand side if you're watching us on Hopin. So once again, thank you very much, gentlemen. Now, Plug and Play. The Plug and Play team have, prepared a FinTech trend report of 2022. Now, if you're excited to get to know more about which technologies and most important, which startups will disrupt the financial industry in 2022, we encourage you to use and download the report. And we just add a QR code. So please now take out your smartphones or just simply click the link. And well, if you have your smartphones ready, just scan the QR code in order to download the report. We'll give you just a couple of moments in order to do so. Yes, pretty simple. Most of the smartphones nowadays just use the camera. You don't need a special app. Just point your camera at the QR code and you will get the option to click the link and open it and download the report. Now, let's continue with the next panel called What Opportunities Does BNPL Hold for the Future? Now, buy now, pay later. The banking and payment space has experienced a high level of disruption in recent years. Europe's highest valued startup, Klarna, has a business model focused on the BNPL. Many established players are also moving in on the space now. More than enough, a reason to discuss where BNPL trends will be going in the near future. The panel will be hosted by Friso Roskam-Abing. He's principal at Finch Capital. And he'll be joined by Christa Holloman, founder and advisor at Divido, Nina Pütz, CEO at RatePay, and Andreas Spengel, Senior Vice President, Market Development at MasterCard. Intro done. The stage is yours, ladies and gentlemen. Take it away.
So thank you very much for the introduction, and thank you very much for the plug and play team. I think we can all agree that hosting events nowadays is quite difficult. I'm super grateful that plug and play is still pushing through and just digitalize this event. Even more grateful that they choose BNPL as a topic of discussion. I think buy now, pay later is like one of the more hot topics within fintech. And at the firm where I personally work, Finch Capital, it has been a hot topic now for several years. Initially, we were early investors in Twisto, the BNPL champion of the Central European region. But we exited Twisto last year to SIP. And now we're back for a second round of buy now, pay later through our investment in Tree. So I'm really excited to be able to have this discussion with a couple of the industry leaders and get their insights on where this space is going towards. But first, maybe for everybody to get on the same page and for all the listeners to get on the same page, I would like to start off with one step back, and that's actually go back to the basics of what buy now, pay later really is. So, Christer, maybe to start off with you, could you introduce the audience to the topic of buy now, pay later?
Sure thing. Well, for me, buy now, pay later is all about making a new line of credit available the very second you need it. And very often it's just for the precise amount that you're making a transaction for. So that's for me what buy now, pay later is all about, an instant credit at the point of need.
Thank you very much. And so, this is the general view of what buy now, pay later is. What kind of differences are there across regions? Like, what do we see in Europe? What do we see in other parts of the world? Andreas, what's your view on that?
Yeah, well, I think, buy now, pay later has been around for a while, actually. And if you look at markets like Australia or the US, they're definitely ahead of what we see in Europe, as they started and gained relevance probably a decade ago already. But there's also differences, I think, in Europe, if you look at Europe as such. And if you then look, for example, at Sweden, there's, I think, roughly 30% of the Swedes are actually using buy now, pay later already. So it's quite established there. What I think is what is more important, though, is basically the commonality, and that ties in with what was just being said. I think the driver for success and also of the let's say high attention it gets is the consumer needs that are being solved. It's flexible payment options, being in control of your finance, and have this great seamless user experience. I think that sets it apart.
Thank you very much. Christer, I have a feeling you also wanted to add something to that, or did Andreas just cover your opinion as well?
He covered everything. But I would say that Klarna in Sweden is well ahead of Australia and the US when it comes to buy now, pay later. They've been around for so long.
And if I may add to that, obviously, me being German, the Germans are actually the most advanced when it comes to buy now, pay later, because actually in Germany, I mean, if you look at e-commerce size, 125 billion, and buy now, pay later accounts for 50%. So that's by far the biggest market in Europe. And then if you look at follows next within Austria or Switzerland or the Nordics, around 30%, basically they're that's most advanced. And I think, Chris, what you've said is the hipster, the hot stuff around buy now, pay later, it being primarily being installments, is also not so true for Germany, because in fact, buy now, pay later has been around in Germany since the 50s with a very traditional payment method. I always say originally invented by the Otto Group, and that's payment upon invoice. That's the classical one that is, at least in Germany, still the payment method with the highest market share in e-commerce of about 30% of all payment methods.
That's really interesting. I actually wasn't familiar with the fact that we started off in the 50s with this. I thought it was something much more recent. And to be honest, I wasn't around in the 50s yet, so maybe that's the reason I missed it. But it's still interesting to understand. So over the last couple of years, there has definitely been an insane boom of buy now, pay later. And loans have been around for decades, and digital payments have also been around for decades. So what kind of explains then the boom that we've been seeing in recent years? Nina?
Yeah, the boom is basically that what Chris said, that online e-commerce is growing hugely. The pandemic has helped it a lot, and you have a very easy tool if you want to have bigger investments where you don't have to go back to your bank and get a loan, for example, but you just buy a new sofa or a new washing machine. You get an instant feedback whether you're allowed to pay, and then basically, so in the German case, you pay with invoice or installments, but typically in the US or in the UK, for example, you split that into regularly 4 installments or so. Very easy, and that has very much disrupted the payment, the way people paid, particularly online.
Yeah, okay, that actually makes a lot of sense. So the recent boom has been basically through e-commerce channels. But then if we're going to look at the demographic and the users of this, it's still a bit my assumption that e-commerce penetration is higher amongst the younger populations, or at least the population that's exposed to digital means through their work or through their regular life. Like, is it then the same for buy now, pay later? Is it more being used by younger people, or do you see adoption across the demographics?
I think it depends on the shop where it's being used and the value of the transaction, who the kind of target customer is. So if you look at clothes, something costing a couple tens of euros, less than 100 euros, maybe the target audience is a 20-year-old student. But clearly, people of all ages, if they're buying something expensive, they benefit from being able to spread that over a longer period of time. And if it's interest-free, which is the case for a lot of transactions, the dividers processing, it's a no-brainer. Whether you're a student or whether you're a millionaire, if someone wants to divide that payment up for you and spread it over 2-3 years even, interest-free. So we see a very broad spectrum from young people all the way up to retired people that just are smart with their money, and why pay interest when they don't have to.
Thanks. That's actually interesting. I think something that also brings us to an inevitable topic, and that's the topic of overcrediting. I think a lot of the noise around buy now, pay later has been very positive, has been around swift e-commerce adoption, a seamless customer journey and whatnot. But we've also heard things about, a potential credit trap that you could fall in as a consumer by stacking up multiple BNPL loans basically on top of each other. So maybe this is a good moment to start off with a statement. So what I'm going to do is introduce a statement about this, and then I first want to hear of all of you three a yes or a no, and then let's dive into the discussion. So the statement would be: regulators are currently doing sufficient to protect consumers from a buy now, pay later trap. Chris, what's your answer to that?
No, they should do more. There's too many cowboys out there, and it's hard for legitimate, real established banks to compete with that because they're not playing by the same rules. So the regulators are doing more things, and they will be doing more things, and that's a good thing. It's going to level the playing field. And
what's your view on that, Andreas?
I would agree to Chris there, and at least that's what we would be expecting. Buy now, pay later is now scaling. I guess the regulators will get more involved in how these lending models are assessed. Let's say suitability and maybe also affordability. At the moment, the credit line is extended to a consumer. So as we are, let's say, a network, I would say, would we be in the position to judge that? No, we would not be in the position. So we are always working with the regulator. But I would expect that regulation will kick in at some point in time. And as long as that regulation creates a level playing field for all players, I think that's a good thing.
Very good, very good. And Nina, what's your view on this?
Also clear no, absolutely clear no. But having said that, I mean, we at RatePay, for example, we don't monetize via consumer revenues. So I'm particularly relaxed on that. Yeah, that's not how we monetize. So it's good that the regulators hopefully become a little bit more active here.
So I think we're all agreeing on the fact that regulators should keep a close eye and definitely protect consumers of this credit trap. But also me now speaking to 3 leaders of industry within Buy Now, Pay Later, what are some things that you are doing yourself in order to prevent this and maybe let there be no reason for regulators to step in? Can you elaborate a little bit more? Nina, you just explained that you don't monetize consumers. What are some more measures that you have in place?
Yeah, so we monetize through the merchant basically. Yeah, we offer a risk-free payment method to them, and therefore they pay us a disagio and sometimes a little transaction fee. And what we do is basically we have real-time risk settings. There's a lot of AI and machine learning involved, and we have obviously limits per basket, depending on the individual virtual or vertical or shop someone is buying from. Also, according to how well we know someone, there's basically no possibility to come into a credit trap, because if we have history of you that you have not been able to pay, then you won't be able to pay in the future. And we limit, so you would never be able to do a first time payment with us and spend thousands of euros. We wouldn't even let you.
Interesting. Chris, how is it as the Divido? Is it something similar in place, or what are some measures that you guys are taking?
So Divido is a white label SaaS platform to enable established retail banks and large retailers to offer Buy Now, Pay Later under their own brand. And in the case of the lenders and the banks we work with, like HSBC and ING and BNP and Santander and so on, they already have their credit policy. They already have the risk appetite well defined, including consumer protections and so on. So they're leveraging that existing know-how and experience and simply present that through our platform. So Divido itself doesn't lend money or decide who gets to lend money. It's all up to the clients or our customers effectively, and they're all established and reputable players.
Interesting. So, and I've been hearing a lot of innovations basically that you guys have been describing. So not monetizing the consumer would be an innovation. I heard some technical innovations about white label, technical innovation about using AI to underwrite your clients. So I just guess this is a space that is very subjective to innovations. And that's another topic that I would be interested in discussing with you guys. So Andreas, what are some of the Buy Now, Pay Later innovations that you expect to come in the next several periods / next several years?
Yeah, well, I mean, what are the innovations? I mean, we had the discussion in the beginning how innovative is Buy Now, Pay Later. It's been around for a while, right? The market is though in the making. I mean, we currently see 200 plus startups competing in the market. And I mean, what is predictable in sense of what's going to happen there is market consolidation. I think that's going to be a big driver also. Strategic partnerships we're going to see. We've seen that Affirm, Amazon, Klarna, Globally are working together. And then I would think that we're going more into these value-added services, like expanding, let's say, the scope of this personal finance propositions, like, I don't know, discounts, shopping recommendations, spending analytics, virtual cards, insurances. I mean, this is basically building a full value proposition out of this, let's say, very narrow proposition that we currently see.
Interesting. And what kind of more innovations would you see in the market, Nina? Or maybe what are some innovations that RatePay is currently trying to pursue?
I think Andreas has said pretty much most of it. What's effect is that the buy now, pay later market in Europe will double until 2026, also in Germany. So there's still huge room to grow. There's still half of the online shops haven't outsourced buy now, pay later yet. Yeah. So this is where the growth is coming from. And then we'll see more of these partnerships, but also then it'll be around offering value added services. So then you have those buy now, pay later players who offer that around the end customers, so the buyers offering value added services there, or you have the classical merchant focused players like us, as a white label player. So we will offer value added services for merchants.
Interesting. And so a lot of this is still happening in the, let's say, digital ecosystem. So a lot happening in e-commerce. Like, will this ever go to bricks and mortar retail as well, or?
I think so too. It's super powerful. So if you go to your local furniture store, and I mean, again, this hybrid way of shopping, this is the future. So why not pay an installment right at the point of sale? And this is just one way of doing it. So whenever you talk about very expensive items that you buy at the point of sale, why not having a simultaneous real-time decision on whether you can pay that in installments, for example, or with invoice?
And this has always been a firm belief of Divido that retail is ultimately omni-channel, right? Like, we work with BMW, which predominantly sells through physical outlets. We work with travel companies like Last Minute. They still do bookings over the phone. So I think it's important as a technology provider that we can cater for wherever the customer wants to transact, and also acknowledging that consumers might touch the retailer at all of those channels at some point during their buying process, and you never know when they're going to want to convert. So you want to be able to cater for them whenever they make that decision. So omni-channel for sure.
Interesting. What are some of examples in the market already of like companies approaching this full omni-channel solutions to consumers? Because the most that I've been seeing around, apart from Klarna, but the most I've been seeing around is still very much focused on e-commerce. But do you have some preferred competitor, let's call it that way, who is already doing the full omni-channel bricks and mortar solution as well?
So what we see is, to your point exactly, the new challengers, they're all attacking e-commerce, which is why it's super crowded. In the offline world, and let's be honest, most of transactions are still happening offline. You're buying something expensive like a car, and that is predominantly dominated by the incumbent domestic banks. Like in the UK, you have Barclays Partner Finance, you have GE Capital, or someone like that will provide those types of facilities. And we see the two worlds coming together. So that's the big thing, I think. We are helping the traditional retail banks to go online, and the traditional online players to operate more effectively offline.
I would agree to that, and it's in the as we are discussing, let's say here, the buy now pay later from the, let's say, the new angle, from the e-com angle. We must also acknowledge that there is this traditional angle to buy now pay later. I mean, consumer finance has been around for I don't know how long, and that is actually let's say the stronghold of the traditional banks. And what we see there is that they also, I mean, they're not just sitting on their hands and doing nothing, but they also are coming up with these buy now pay later value propositions. I mean, you've seen it first with the fintechs, obviously the Revolut, the N26s, the Monzos. But if you also look at the high street banks, you see the same. They're developing that. Sometimes they're developing that on their own. Sometimes they're doing that in collaboration with partners. Sometimes they buy something. Some of them even take our APIs. So MasterCard is providing APIs in that region for installments and buy now pay later, to actually also scale that. Because for us, in the end, this is also means volume, means more usage, means more customer interaction.
And on that, to expand a little bit on that, you indeed explained that, for a typical consumer loan, you would go to your bank. Still, it's the new kids on the block disrupting this industry. What is still the role of retail banks within this space, or do you see them catching up with fintechs, or what's your view there, Andreas?
I mean, what Krista said. I mean, let's be clear. I mean, if you the majority of retail is still happening at POS, right? And that is, and if you look who is handing out the credits there, the buy now, pay later, right? Maybe not in the most fancy and sleek user experience, but that is the traditional banks, and they are now upping their game in that area. And I would say we will see all sorts of consolidation. What I said earlier. I mean, currently we see 200 plus specialists out there. Some of them will be integrated into, let's say, high street banks. Others will survive and will consolidate. I mean, also all the money that has flown into that market. Friso, you're at Finch Capital. If you're saying you just exited Twisto, there will be a natural movement in the market, and I think the safest bet will be the 200 will not be 200 in 5 years from now.
I think to expand on that, that's indeed a little bit our investment thesis within Tree now. We still feel there's a lot of white space to be taken up. There's a lot of competitive dynamics within the buy now, pay later space that in Tree focuses on in a very elegant manner. So we indeed also have the feeling that 200 buy now, pay later providers in Europe is probably about 150 too much. And given the dynamics of consolidating in this industry, in which the larger you get, the cheaper your debt financing should be, there's also a lot of sense in consolidating. So indeed, that is our thesis for the years to come. Consolidation needs to happen, but with still enough white space and still enough place for synergies, we expect that this will be a interesting area to still be invested in.
Absolutely. So don't get me wrong. I do think there is growth in that segment, and it's a complementary to what we see currently, and let's say the participation effects, or let's say the new revenue segments that you can tap into are larger than what you see from a cannibalization point of view. So it is a win-win situation in the end for all, by the way. And I think that also in the sense of the consumers who have that user experience, that flexibility out there. And then if you then what we discussed earlier also have the evolution of the let's say the regulation, I think this will be an established market segment in a couple of years. Still growing.
Yeah, I definitely agree to that. But then if I look at the valuation of some of the players currently in the market, you would think that it's not an industry in evolution, but a full-on established industry already. Like looking at the cap tables then, and obviously a lot of tech companies got a beating over the weekend, and like they've dropped 10 to 20%. But still, if we're looking at Deutsche Bank today, there's like 20 billion market cap. If we look at ING Bank, that's 45 billion. If we look at Commerzbank, that's anywhere between 8 and 9 billion euros. So that's for the traditional financial players. But now looking at the buy now, pay later players, you're looking at a firm today of around 50 billion euros market cap. So they're actually larger than Commerzbank. SIP took a beating, let's be honest about that. They're now about 2 billion euros market cap. But then you have Klarna absolutely flashing everybody out of the water with a 40 billion valuation. So actually kind of close to, or at least in the private market, to what ING is worth in the public markets. Krista, you as a founder within Buy Now Pay Later, you must be really excited about these stats, but also at the same time, like, what is your opinion on the valuations that I just shared?
Well, I think the market always knows best. And if this is how they value the companies, because that's what they believe the company is worth. And I think Klarna is obviously extremely successful, and they're just getting started. Remember, they have fantastic penetration in North Europe kind of thing, and they're only getting started in the US. So imagine when they have been getting another 50. I mean, how long has Deutsche Bank been in business? For several decades. If you give Klarna as much time, they're going to become even bigger because they're going to be global. And they're not just about lending. It's about loyalty. It's about discovery. It's a lot of other things that kind of fold in to kind of add to that valuation. So I think the valuations are correct. Too low, if anything.
That's indeed what I would like to hear. What's your view on that, Nina?
You see it, like Chris said, that's the demand. And obviously the whole thing always goes in circles, but there is still so much more room. And as we said, we are in the early stage of buy now, pay later. So there will be double the size up until 2026. So they are what they are. As long as there's enough demand and the consumer demand, then that's it.
Interesting. I think we spoke about basically the majority of the stakeholders within buy now, pay later, but one super important one still has not been addressed, and that is the merchant. That is the merchant selling goods to consumers. I can imagine, for merchants, this is also a interesting time to be living in, because there's so many different payments and lending solutions. Like, Nina, what do you feel a merchant should really understand about integrating buy now, pay later solutions into their offering?
In the end, what do you want as a merchant? You want to have the highest possible checkout conversion. In order for you to have that, everyone who has put something in the basket where you paid lots of money for buyer acquisition, those people should be able to check out and pay as easy, as seamlessly, as integrated as possible. Therefore, I would say, hell not. If you as a merchant haven't integrated buy now, pay later yet, do it. And the numbers show exactly the same. So we looked at how have the top 500 online shops developed over a period of 3 years, if they had buy now, pay later versus if they hadn't buy now, pay later. So those who had buy now, pay later were growing 46% stronger than the others. So there's a difference, plus 46 if you have buy now, pay later versus you haven't. If you have buy now, pay later, there's also a difference whether you have this insourced or outsourced as a merchant. Those who have it outsourced grow 25% stronger. So the case is very, very easy to maximize. If you want higher conversion, then use buy now, pay later. And then there's a difference. Obviously, there are different buy now, pay later service providers. Some are white label, like we, for example. So everything is in the look and feel of the checkout of the respective merchant. And then there are other branded players where you go and exit and go to a special site. And there is also data, for example, that if you compare branded versus unbranded buy now, pay later checkouts, you have half the checkout abandonment rate if you have a white label solution, because people don't have to exit. They just go as easy as possible through.
Okay, and with that final bombshell, I think every merchant tuning in here now will be giving you a call afterwards, Nina. So I think we have to wrap up this panel. I would like to thank you all three very much for your insight and for taking the time here. So thank you kindly, and definitely to be continued.
Thank you, Friso. Have a great day.
Thank you.
Thank you very much. Have a great day.
Added to the chat. I think we put it in the comments on LinkedIn as well. We added to the YouTube chat as well. And forget about the QR code. That didn't work as planned. So if you're interested in the trend report and if you want to download it, just click the link. And I think we added it in the lower third as well. No, it's up. No, it's down. I'm just getting hints from our director here. And we will now continue with something really exciting. We will continue with the startup pitches. and they will be presented by our, well, I can't find a word because I only known her for like 2 hours, but she is from Plug and Play Ventures. Welcome on stage, Anna.
Welcome. Thank you for the introduction.
I actually just wanted to introduce you but you don't say beautiful anymore because this is too gender specific. But I think you're really talented about ventures and you are presenting the startups today.
Exactly.
Are you excited?
I'm super excited.
Okay, the stage is yours.
Thank you very much. So, hi everyone. Today we would hear the startup pitches of 9 different fintech startups covering open banking, verification tools, core banking, and sustainable finance. You will now hear a 5-minute pitch from each of them. And after the pitch, you can ask them questions, network with them in the expo session in Hopin. You will also be able to vote for the best pitch of the day. To do so, please go to the poll option in Hopin, which is in the right-hand side next to the chat. And now let me introduce you to the first startup. Let me welcome on stage Piotr from ABAKA, which is building AI solution for document automation. Welcome, Piotr.
Hello, everyone, and welcome. Are you able to see my screen?
Yes, we are able to see it. The stage is yours. Please remember you have 5 minutes.
Sure. So, hello, everyone, and thank you very much for having us today. Today, I will show you the future of documents processing, thanks to deep learning intelligent platform that ABAKA create. So I know it will be helpful for you to have some context about ABAKA and what we do. So we will start with the business challenges we are designed to address. ABAKA helps customers replace paper-based workstreams that require human processing of documents with digital workstreams that are automated. The role we play is to take information that is trapped within the documents, extract it, and structure it within the machine-readable formats that allows it to enter a large digital ecosystem. The challenges is that the corporate data is generated in the formats designed for people to read, which require human staff to manually input data into the core system. We covered that data into the format that enable digital processing, so information can flow directly into your system, much less human intervention. The goal is to operate faster than a human speed, so you can process more documents within the same staff, process more documents quickly, and maybe win more business because you can make approval decision in minutes when competitors take hours or days. Improving throughput means you can process twice as many documents without additional staff. Having your operation officers spend less time keying data into the core system means you operate more efficiency and reduce net costs. Beating your competitors thanks to the quicker approvals decision process making helps you gain more shares. Having everything in digital forms is the first step toward easy audit. ABAKA has created a proprietary language model called TILT that learns layout, visual aspect, and textual semantics, along with remarkable ability to read graphical embedding. ABAKA is able to extract information from all types of documents thanks to deep learning methodology. Let's compare some legacy system that is available on the market. On the right-hand side, we do have legacy template and rules-based solutions, which do well with the structure formats but cannot handle document variability, where the formats of the documents does not match the layout coded in the template. On the left-hand side, NLP solutions do well with the unstructured text, where it is important to understand the sequential meanings of the word. But this is all they can process. NLP solution overcome the limitation of the templates, but by treating everything like a plain text. But if you can understand those textual semantics as well as the information that is transferred by the formatting of the page, then you can operate in a 2-dimension. And actually, we are using the 2-dimension methodology to extract information from documents. We are focusing on the data which is around the information that we would like to extract. That helps us to understand the context of the information and we are giving a particular value to this information that we would like to extract, like address, for example. We are running interpretation of full documents that give us an ability to extract information which is not explicitly mentioned within a document. And based on this contextual extraction interpretation, we are able to run suitable business decision like human will does. The main problem that we will solve is the documents variability. Thanks to the deep learning that we apply to the intelligent documents processing, We allow our system to create the rules independently on how to extract information from document, which means that the documents template is not important for us. We are template-less company. We prepare our model, we pre-train it in hundreds of millions of documents from the public domain, which means that we requested very limited data to train a model within the new use cases. The only things that you need to do is to learn and train a bit, to show the platform a bit more context, what you are looking within the documents. So uploading few documents and pointed out exactly what you want to extract from documents and pointed out where this information is. This is a very similar journey that you need to follow within the new joiner of your team. I know that it might sound too good to be true, so let me show you a couple of facts. We outperform tech giant in the world NLP challenges like Semival or IGDAR. On the yearly basis, we are winning with the tech giants like Microsoft, Google, etc. And the documents that we are processing is very similar to the ones that you are processing on a daily basis. So I know the natural question will be how big we are, that we are able to outperform tech giants. Overall, ABAKA employs something around 100 employees, but let me focus on one thing. Majority of our employees are actually working on the research and development and product development teams, which proves that we want to solve the problem that our clients have. Within our 30 plus PhDs on board, we are solving the problem of variability that we have in here. This is just a snapshot of the clients that we are that already entrusted us. And if you will be willing to learn more,
unfortunately, we need to cut you here. The 5 minutes is gone. We need to move to another page, but it was great. Thank you very much for all the details and insights. And now on to Marcelo from Divido, which is connecting lenders, retailers, and channel partners at the point of sales. Hi, Marcelo, are you with us?
Oh, hi, Anna. How are you? Can you see me?
Yes, we can see you. The stage is yours. You have 5 minutes.
Thank you, Anna. So, as Anna was saying, my name is Marcello Silvestri. I'm a sales director for Divido. Divido is a white label retail finance platform that helps lenders to get to market fast using their own brand. Thanks to our technology, we connect lenders, consumers, and merchants seamlessly online and at point of sales to make sure that we create a new way of payment. Specifically for lenders, Divido, if you can say, offered for lenders a solution that powers their point of sales finance, making sure that the banks have full control on data, user experience, and customer journeys. Just at a glance, some numbers. Divido has been in the market for 5 or 6 years now, and we have the luxury of having raised 37 million, thanks to investors of the caliber of ING and HSBC. We are live across 8 countries, and we have already across approximately 1,500 merchants, thanks to our merchant plugins. Now, why we are focusing on retail finance? I'm sure you may have seen already a fantastic panel with Kristen, Nina, and Andreas, who were really talking about BNPL and how this is getting the market very quickly. And the reason is quite obvious. Consumers like to check out with one of the retail finance options, of which BNPL is one of that, because it's easy, because it's immediate, and because that allows them to spread the cost of certain items across several months. This benefit, of course, comes to a cost, if you want, for retailers and for banks. A cost for retailers because they have to pay the so-called super apps a certain percentage per each purchase. And a cost for banks because the client are almost forgetting their credit cards, because by using the BNPL super apps, they are stopped using the credit card traffic. So the banks are noticing a drop in the revolve traffic. Now, what we're noticing that the common challenges for retail finance offered by the banks is summarized here in this slide. First of all is the speed to market. Large banks are not really famous to be fast and to be reactive at market trends. That's why quite often they partner with fintech like us. They don't have the expertise of explaining and offering retail finance to the large merchants. Their API quite often is not so sophisticated, therefore it could take a long time for them to onboard one merchant. And then there is the cost. Usually build a retail funds proposition is quite expensive for a bank. That's why they are coming to us, because thanks to our SaaS model, we can offer them a proven platform. As again, we are live in 8 markets. We offer the banks full control on the customer data, user journey, and customer experience. We can get to market very quickly. I know that we launched a bank in South America in only 3 months. And we offer a very vast merchant integration with approximately 1,500 merchants already plugged in into our system. This slide hopefully summarizes our strength, and I'm looking forward to network with you later. Thank you, Anna.
Marcelo, great pitch. The next in line is Suren, who will introduce us to ETFAS, which is building a digital platform for value-added services. Welcome on stage. Are you with us?
I am. Sunny regards from rainy Hamburg in the beautiful north of Germany.
Perfect. The stage is yours.
Thank you very much, dear global audience. I'm Sören, one of the 2 founders of ETFAS, and I'm happy to present to you the customer engagement platform for transaction-linked offers. So Netflix has videos, Spotify has music, and banks, they have user payment transaction data. And we help banks leverage the banking transaction generated by consumer daily spendings to make highly targeted offers to users of banks. We asked banks in our B2B survey, and they state that they face low customer loyalty, and they often miss strategy to target users based on their users' needs. And they also have issues with IT resources to develop own digital solutions to address the needs. We also ask users of banks what they want, and they expect more than banking. Users want only relevant offers and pay less. Even more, they don't want to pay for standard offers. Poor user experience makes users switch the partners. And here's our solution: the platform to deepen user engagement and drive loyalty with rewards that helps users save money and receive targeted offers. So we serve 3 groups. It's banks with an easy to implement revenue generating user rewards program, their bank customers with easy savings and highly relevant offers, and marketeers who can bring offers in front of bank customers to increase touch points and foster deeper connections. So everything happens in one platform with only one integration. We connect users of banks with all marketeers of cashback offers, value-add service, or insurance, everything in one platform. So how does it work? In our B2B platform, the marketeer creates an offer for a retail cashback, an insurance product, or a value-add service. This is brought in front of our banking partners. From their B2B partner studio, they can publish the offer to their banking users. And whatever they offer, the user sees in their end customer portal integrated in your banking app or into your online banking. So either a retail cashback, which is directly paid to the account, set and forget, a cashback on a local coffee shop, or maybe something else, or a restaurant in the close area. And also based on transaction data that we access, we can now make highly targeted offers. This example, there is a Vodafone subscription. The customer gets offered Vodafone customer gets offered a smartphone phone loss protection. So based on transaction data. So this is all happening with the ETFAS Automat, which is AI that automatically delivers contextual transaction-linked offers to the best customer experience. We support PSD2 open banking integrations or deep integrations into banking apps. So the user engagement is easy. So first is the deep integration or open banking usage, and users connect their card or their account. Then they activate offers and pay with the linked card. The cashback is calculated and paid directly to the linked bank account. And then on top, they get offers in context to transaction data. So it's a bank revenue model. So there is one setup fee with ETFAS, but then banks earn 10 to 40% either on the cashback paid back to the customer or on sales like insurance or value-add services that we can integrate with online banking apps. We have just proven as we are integrated with the online banking of German savings bank. So it's a win-win-win. Banks get loyal customer, higher engagement, also higher revenues, and marketing opt-in. This is actually a marketing opt-out wonder channel. Marketers, they get loyal customers and an effective marketing channel in a secure environment of banks. And bank customers, they save money and they receive highly relevant offers for more freedom in their daily digital lives. So in getting started requires actually nothing of your IT. If you start with our fully white label hosted portal, you can extend the offering with the full integration into web members area, mobile apps, or online banking. So if you're a bank, card issuer, or TPP, please connect with us for a demo. We're looking forward to it. Thank you very much.
Lovely, thank you very much. And now we would like to welcome on stage Tim from Fireblocks, which is a blockchain cybersecurity service provider for moving, storing, and issuing digital assets. Are you with us, Tim?
Yes, absolutely. And can you see my screen?
Yes, it's perfect.
Now you can see. Okay. Yeah. Thanks for inviting me. Really great to be here, to the people wherever they are right now. So yes, Fireblocks. We are a technology and cybersecurity company, 4 years of age. We're actually a scale up, and we basically help institutions to get into the digital assets realm. And the real backdrop of that is that we had spotted opportunities early around the trend around Web3. So going from Web1, which is basic consumption, Web2, which is largely being also contribution. And then now Web3, I guess many people have heard about the term metaverse and NFTs and crypto. So these are obviously very large opportunities around the Web3 realm. Again, that all comes with very distinct challenges. From our backdrop, being a cybersecurity company, we did spotted this as a very substantial opportunity that needed solidification around the security of specific assets there. Specifically, going one step deeper, there's 6 very distinct areas we look at right now. These are constantly expanding. I think some of that is really well known to the audience here. Things around crypto, investing in Bitcoin and crypto assets, but also the use of digital assets for payment, remittance and corridors, clearing and settlement, even digitizing traditional assets. Deutsche Börse is a good example. Also tokenizing and making the largest asset class on the planet accessible to a wider audience, that is real estate, is kind of great interest of us. All of that combined actually does require deep technology infrastructure. And again, that's something we deliver on a daily basis. To really top on that one, we do believe that blockchain is not just hitting the financial markets or the financial system at large. It will be impacted there first, but we already see vastly different applications. And again, these all have very distinct cybersecurity threat, which we aim to solve for every day. Old infrastructure, again, we had seen this. These are snippets in the press. There's new ones coming almost every day that assets had been stolen. Crypto can't be accessed any longer. So this is, again, something bound by old infrastructure that is not capable to deal with the elements of the growth around Web3. So where we are, what we provide is actually technology basis that is around the safekeeping of private key material. So making sure that digital assets at large are not being removed without authorization, and also making sure that the transfer of digital assets is being done in an utmost and secure way. Where are we today? So we were founded almost 4 years ago. We raised almost $500 million worth of funding, with the latest funding round being announced last year in July. That was a $310 million funding. We do have more than 800 customers. All of them are institutional customers. One or several of the really prominent ones are obviously the BNY Mellon, Revolut, and eToro. So some of the stuff is really around crypto assets to start, but we do see far more applications around digital assets and even tokenizations. From an investor basis, I think it's also very obvious that these are the who's who of VC investors. Again, I do like to also highlight BNY Mellon as the largest custodian on the planet, having more than 45 trillion assets under custody, being a investor in Fireblocks. So the customer base is changing, and this is really my last slide here to show. Yes, we're dealing with lots of digital native companies, crypto native companies, but it's slowly drifting towards the large scale financial institutions. And we have seen announcements around banks that are interested in exploring digital assets. And our expectation here is to see more and more traditional financial institutions going into the digital asset space. And again, this is something we help them to achieve on a daily basis. That is pretty much it. Thank you.
Your team, great pitch. The next in line is Open Legacy, which enables enterprises to build, automate, and manage legacy integrations all in one place. Let's welcome on stage Gil. Gil, how are you today?
I'm good. Thank you very much. Yeah. So, hi everyone. Hi everyone. What we're going to talk to you about today, I mean, is probably the #1 issue in almost any digital transformation, almost across any sector. And since we cannot do question and answer, I will just tell you the biggest challenge is always not what the digital platform that you're trying to bring and the new services that you're trying to introduce is how do you bring all this digital innovation into the existing ecosystem. And that's exactly what Open Legacy does. Open Legacy provide a platform that helps the organizations to actually accelerate, simplify the whole generation of digital and cloud native services. So my name is Gil Cohen. I'm based in Switzerland. I'm the general manager of Open Legacy, part of the founding team. And we've been in business since 2014. We already have success stories from pretty much all over the world. You see some of the name on the right side. We are mainly engaging with financial services, but not only. We have also retail, telco, manufacturing. The common theme between all of them is actually that we are helping them to unlock the data and the business logic that they have in the core application and being able to expose them as modern services. So if I have to look at high level and explain you what Open Legacy does and where does it sit. So these on the left side, you see the different core applications that most large enterprises will have. Open Legacy has experience working with dozens of and different flavors of all of these core applications, all the way from the mainframe, AS400, customized solutions, homegrown solutions. The more complex and difficult it is, the more value typically we have. The kind of secret sauce of Open Legacy is the ability to parse automatically metadata from the core application and being able to expose them as now modern services, and doing all of this without being intrusive into the core application. So typically for the clients, we're not asking them to make any changes. We show them how we automatically expose the metadata and now giving the ability to build and design services in a modern way. So if I have to summarize, since it's a really 5-minute speech, I mean, if I have to summarize what we are actually doing in 3 points. So one is really how do you actually turn the existing assets that you have that have been customized, that are working well for your business, into an API-enabled product and services, and being able to support your migration strategy, typically towards the cloud, being able to unlock the islands of data that you have and try to and turn them into a generating revenue initiatives. And last but not least, but also provide you just a modern access. So how you can have young talent coming and starting to build services in the way as if you were a greenfield, and being able to do it much faster and easier and in a standard way without having any vendor lock-in. So how exactly it's being done, again, we'll touch on it just in a little bit, but basically what you see Open Legacy is kind of taking care of three main things, which is kind of generate, extend, and manage. So as you can see on the bottom part, there is a lot of different types of either applications or databases or protocols that we know how to talk to. We are automatically generating a modern object out of them. And then we give you the ability to either working in a no-code or low-code option, but also giving you the option to work as a full code and extend the functionality and develop any channel logic that you need on this on outside of the core application. And of course, manage, because we want to encourage reusability and standardization across the organization. So as much as we're showing that we are a layer, we are actually providing you the ability to generate microservices from your monolithic core applications and being able to extend them. So just to summarize, again, the key differentiator of Open Legacy is really our ability to automate the access to the core applications, enforcing the standardization and reusability by building blocks that can be reused by anyone in the organization, and giving you the ability to decouple the integration from the core application. I think this is a key thing, decoupling the whole integration logic from the core application, again, just because it's so painful typically. The approach that we are taking, I said it at the beginning, I mean, we are helping you mainly in the design time. So Open Legacy uniqueness is that we are not on the runtime, we are not there. I mean, we are generating a standard microservice that can run on whatever environment, either on-prem or on any of the cloud platforms.
Unfortunately, we need to cut you here and move on to the next founder. Thank you for your great pitch. And now we are super happy to welcome Julia on stage from Helios, which is a sustainable banking alternative. Hi, Julia, we are happy to have you here.
Thanks for your invitation. Can you hear me well and see the slides as well?
Yes, everything's perfect.
Well, thanks. First, hello, everyone. I'm very happy to be here today. So I'm Julia Menayas. I'm the co-founder of Helios.do, and I'm here to talk to you about sustainable banking. So a bit about Helios. Helios, we are on a mission to bring eco-banking to everyone, to make retail banking green again somehow. And we're building a new kind of bank, what we call an eco-bank, that supports a fairer and more sustainable society. So we are actually fighting global warming through ending the investment of banks into fossil fuels, mainly so fuel, gas, etc., that are highly contributing to the global warming. So why do we need to actually discuss sustainable banking at first? So at the moment when we talk about your individual carbon footprint, actually your banking accounts contribute a lot to your individual carbon footprint. So anything more than 25K on a bank account, sitting on a bank account, you actually contribute, you pollute more with through what your money actually finances when it sits at the bank than through everything that you consume, from shopping to housing to commute and travel. So actually choosing an ethical or sustainable bank is a very effective lever to diminish your individual carbon footprint on a yearly basis. So with Helios, we make this possible with by opening your account in only 8 minutes through our mobile app. So if you go to the Google Play or App Store now, you'll see our app and you'll be able to actually open up an account and start so contributing to the ecological transition from the first euro on your account. So this model actually has a name. It's called an eco-bank. So it really echoes the term neobank that was hyped like 10 years ago or so. But eco-banking is really the future of banking. So what is an eco-bank? The first thing is being truly sustainable. So we at Helios, we direct the deposits of our clients, so all the money that we get on the accounts, to the ecological transition, so that you have a positive impact through your bank accounts. Second, we are on a mission to deliver the best digital banking experience possible. So obviously, this is a very competitive space. There are a lot of banking apps out there, so we strive to make the best digital experience possible. And finally, we deliver this experience with a 100% transparent approach, meaning that with Helios, you actually know where your money goes and what does it fund. So all of our investments are 100% public. You can see them on the application on our website and actually understand what your money is being used for. And this is very different from a conventional bank, actually. So Helios, we've been live for 1 year already. We fundraised 1.5 million euros with investors, tech investors and impact investors in Europe. And we have now built the sustainable alternative to a conventional retail bank. So we have a current account. We have a web version to manage your accounts. We also have available a youth account and a shared account to manage your account with 2 people. And very soon we'll be launching the sustainable savings account as well. So now you can actually manage your day-to-day finance and banking needs on our platform. So we actually deliver the best banking experience you could think of, obviously, with impact indicators as well. So you have green cashback, also a community forum when you can actually explain what you want for the future of Helios in terms of products and functionalities. And we have gamified the whole experience to help you through the stages of your own transition through a more sustainable lifestyle. But this is delivered with a positive and concrete impact. So €0 on our accounts are actually fueling fossil fuels, but also other industries that are harming the environment, biodiversity, or the people. So we do not invest, for instance, in pesticides, for instance, or factory farming, obviously armament, etc. And on the other side, we've been already able to avoid the emissions of 10,000 tons of CO2 and still growing. So in a nutshell now where we're at, so we have more than 6,000 paying clients. At Helios, we are now expanding in France, Belgium, and hopefully across Europe. And we are now closing our Series A. So there's still a very tiny chunk of the round that is open. So any investors out there, happy to connect. And you can discover more about Helios on helios.do.
Perfect. Please remember that after the pitch session, you can always connect with the startups in the expo section of the Hopin. Thank you, Julia. Now stay with us as we will move on to Till from Toom, which is building the next generation core banking platform. Welcome on stage, Till.
Thank you very much. Hello together. Here you see a picture of Tallinn, the capital of Estonia. Estonia is one of the leading countries in terms of digitalization. Since the independence of the country in 1991, the country was really pushing forward the boundaries of what is possible through digital processes. This is the environment where basically Toom platform is born. Our founders here, namely Jan, Wilve, and Yuri, you see here on this picture, back in the 90s, when in like the most countries in the world, a digital bank was still a far away dream. They were working hard on establishing Hansa Bank, so the largest commercial bank in the Baltics, and also the first digital bank basically in the world. Later on, basically, they drove forward like the spirit of innovation and founded a company, what was called Icefire, driving forward digital innovation and transforming multiple financial institutions and banks throughout Northern Europe. As a result of this, throughout this long history of developing and digitalizing, there has been an enduring vision, a vision of using technology as an enabler rather than a cost center. It is this vision that has continued to shape the approach of this team of innovators, and it is this vision that was the driving force behind the creation of Toom, a next generation core banking platform, which serves both like banks, so like the incumbent banks in their technology transformation, also like, of course, the greenfield approaches like the neobanks in the market. And last but not least, of course, also like embedded finance use cases beyond like the traditional financial institutions. Our core offering is consisting of 8 key modules and supporting capabilities. We have here the banking core, which basically is the heart of each and every core bank, banking infrastructure, where the accounts are managed. Here, we basically provide the capability to all that banks and other financial institutions can offer, like really this multi-currency account, Neo-type, Revolut-type account offering to their clients. In the lending here, we provide the full scope of like consumer, retail, SME and business banking lending capabilities. We have a full-fledged cards module which manages cards contracts authorization and like the full cards like contract lifecycle. The payments model, of course, to execute SEPA and SWIFT payments. A deposit module which basically allows you to grant a client a term deposit and savings. Asset and collateral module to support basically secured lending use cases. A debt management module which basically allows you to track also the debt of, let's say, less performing loans. And last but not least, of course, the financial accounting to provide in real-time manner. And this is also very important. The whole system is real-time. There's no downtimes. It's really like asynchronous data management, which is also reflected in the financial ledger. We are modular by design. First of all, this is very important. Then we are API first. So it's easy to integrate our solution into existing also ecosystems and infrastructures. We have a multi-deployment like approach where we could both like provide our services on SaaS on like each and every like larger cloud provider, or even on-prem if this is desired by the institution. Our solution provides the full retail, business, banking, and SME banking capabilities and is compliance by design, at least. Here we have multiple use cases. 3 of the use cases are shown here on the slide. One of our clients is a very large banking group consisting of 180 cooperative banks. There we implemented our lending module, which supports the consumer banking loans, loan cases, providing the real-time general ledger, and last but not least, support the web-based user interface through like API integration. We have the mobile finance provider operating in 23 countries. Here we implemented a large stack of our modules, like the banking core for the accounts, the payments, the deposits, lending, and of course, financial accounting. The specialty here is really that the new core banking system solution we brought up here was operational and replaced the old one in only 5 months. And last but not least, a medium-sized bank in the UK market where we have a greenfield launch of retail and business banking. And this bank basically hosts over 140 regulated entities on their platform. To sum up, our platform provides an immediate positive impact, no need for a long transformation project, support near-term, short-term goals, and is future-proofing. Thank you.
Thank you, Theo. Great pitch. And next in line is Todd from Token, an open banking payments platform driving the shift from card to bank payments. I will leave the stage to you, Todd.
Thank you very much. Good. So hopefully everybody is seeing my screen. So I am Todd Clyde. I'm the CEO of Token. And Token is an open banking payments platform that's driving this shift from traditional payment methods like the use of cards and wallets to account payments. So Token provides connectivity for payments, Token provides infrastructure for connectivity and for payments for account-to-account payments. And we provide this to some of the largest payment providers in the world, and we're powering many of the successful open payment propositions in the UK and in 16 other countries in Europe. So open banking is solving many of the barriers of adoption of account-to-account payments, and these leading companies are buying into Token's vision to make account-to-account payments no longer a niche alternative payment method and really to become a mainstream form of payment. So open banking, it's one of the largest disruptions that have hit the financial services industry in a generation. It's really enabling a whole new layer of fintechs that are an enormous threat to traditional financial institutions. Most impressively, open banking is really going to fundamentally change the payments landscape and really allow account-to-account payments to become a mainstream form of payment. So what do I mean by account-to-account payments? Because every payment originates in the bank account of a payer and ends up in the bank account of a beneficiary. What we're talking about is how the fund settles. So when I say traditional payment methods, I mean that they settle over the intermediaries of a credit card or a debit card or wallets. And these intermediaries add both cost and friction. So merchants have been willing to pay this higher cost because there's been unsurpassed reach and conversion from these payment methods. So what I mean by account-to-account payments are one that settles directly from bank account to bank account over the national clearing systems in each country. So think Elixir in Poland, Intrapay in the Netherlands, Faster Payments in the UK, SEPA Instant in many of the EU companies. And because it removes intermediaries, account-to-account payments has the opportunity to significantly reduce cost while delivering good conversion rates and good reach. So this is the user experience that I'm talking about. So rather than choosing a pay by card when I'm ready to pay at a merchant, I choose pay by bank. I then select my bank, and it's as intuitive as logging into your mobile banking to authenticate a payment. So I simply log into my bank or authenticate with my bank and approve the payment. So this gives me incredible reach. You can reach anyone with a bank account. There's no intermediary to sign up to. It's extremely intuitive. There's no data entry to do. And we're seeing now high success rates and a good user experience. So conversion rates are actually converting better than cards. So account-to-account payments are certainly going to become mainstream because it's better for everyone in the ecosystem. So it is better for payment providers in that it helps them avoid disintermediation and bring a new payment proposition to market to generate additional streams of revenues. It's much better for businesses and merchants, so it gives them a significantly lower cost form of accepting payment that settles immediately, that converts better and has equal reach to cards. And lastly, it's better for consumers because it really is more convenient. I'm not holding a card and typing in my card information, and it's much more secure than having card information, or much more secure than traditional screen scraping methods where I actually typed in my bank credentials at the point of payment. So given that the benefits, or that it benefits everybody in the ecosystem, account-to-account payments are projected to become a mainstream form of payment. By 2023, it's expected to become 20% of all e-commerce payments in Europe and will surpass the use of either debit cards or credit cards. And it's projected by others as certainly becoming a mega trend in the next 5 years. So as I said at the beginning, Token provides an open banking payment platform, and it is a leader in open banking payments. We are certified to perform the first API-based payment. We launched the first SEPA Instant solution for merchants in partnership with BNP. The volume is still relatively low, but growing quickly. We're doing 10 million annualized transactions for 4.8 billion euros. And Token drove 28% of all expansion in the UK last year and is doing about 1 out of every 5 transactions currently in the UK. And as mentioned, we are live in 16 European countries, and we're currently growing at about 300%. In about 6 different countries in Europe. So thank you for your time. If any of you are interested in offering account-to-account payments to your merchants and launching a new proposition, would certainly be interested in talking to you about making that a reality.
Thank you, Todd. Thank you very much for joining us. And now, last but not least, let me welcome on stage Rachel from Trust Elevate, which is solving the problem of age verification and parental consent for young adults and children in online transaction. Welcome, Rachel.
Thank you. Hi, so Trust Elevate, we are an eKYC provider for under 18s. We enable digital onboarding of child and teen bank accounts, and we've been described as the next billion-dollar business. Your future customers, 92% of kids are online. That's 123 million children in the UK, Europe, and the US. These children, 80% of them don't have a bank account, largely because of the friction involved in having to physically go into a bank with a parent. 66% of these parents give their children an allowance, which adds up to 48.5 billion per annum in the UK, Europe, and US. 121 million children do not have bank accounts. That's an opportunity cost, and that liquidity should be in banks. The cost of customer acquisition is $260 per user. Trust Elevate reduces that by 40 times, right? By 40 times. So that's a new market and a revenue uplift, potential customer lifetime value of 790 billion. So our eKYC youth product has been evaluated by Accenture Fintech Innovation Lab. We're very proud to be part of Plug and Play. We're part of the FCA Regulatory Sandbox. We've been through the ICO Data Protection Regulatory Sandbox. We've been security pen tested by GCHQ, and we're working with banks. We recently participated in the Global Open Finance Challenge, which is all about startups getting access to open APIs. And this demo will hopefully work. So I'm a bank. I have a bank account. I log in the usual way. I then do co-banking with my family. I want to create a child bank account. We permission Trust Elevate to have access to the parent's account, and then the parent enters the child's details, which is first name, last name, date of birth, nationality, etc. And you have a bank account open. So we're in line with AML and KYC requirements. We don't require any facial scanning or documentation like that. So our products we enable a number of sectors that have to meet regulatory requirements. So it's not just banking and KYC and AML, it's also social media and gaming platforms and mobile operators that have to comply with the General Data Protection Regulation, which requires them to obtain parental consent before processing children's data. So we enable payment initiation service providers and AISPs also on these platforms. We have a product for my family. We have an API and SDK for mobile operators, for the likes of Xbox, TikTok, Facebook. For KYC Youth is for banking and fintechs, and Age Check is for those marketplaces that just need to know your age. So we enable companies to meet compliance requirements across business verticals and business sectors. So you can see why we're the next billion-dollar business. We seamlessly enable customer onboarding. We're a zero data, zero knowledge, zero trust model. So that reduces the regulatory exposure. We can enhance the return on investment in terms of sales and marketing because you're targeting the right people. We limit online harms on social media and gaming platforms because when platforms know the age bands of their users, they can create safer spaces. We can enable in Payment Services Directive, we enable secure customer authentication requirements and authorization and the sale of age-related process. Our business model is a licensing model, and we have a per managed child per annum subscription, and you can see the prices there. Our channel partners, every single parent has their phone with them the whole time. For social media and gaming platforms, when they're permissioning children's access to and the data processors who are associated with those platforms, we can enable that via the native mobile operators app. We've also got a partnership with Commerce Tools and working with Amazon, and we will work with the larger RegTech providers to the banking and fintech sector. You can see by 2024, the identity as a service market for under 15s is expected to be worth 1.6 billion. And you can see the serviceable addressable market. So within 5 years, we'll have 98 million. That's 8% of the total addressable market. That's what we're aiming for. We're currently we're fundraising. We've been through an angel round where this is a pre-series A round. Our ask is for 2.3 million. That was to build out our team and enable us to exploit the market. We have a first mover advantage. I'm the technical author of the technical standard that underpins how you do identity attribute verification. It's an ISO standard. And I have working with me some extremely well-renowned people like David Clark, who's a data security expert, and we have advisors. So thank you. That's Trust Elevate. I'm okay time-wise? Yes.
Thank you very much. Perfectly in terms of time. I'm crossing my fingers for all of the startups to achieve at least the unicorn status anytime soon. And now it's time to vote in the poll section of Hopin on the right-hand side next to the chat for the best pitch of the day. You heard today 9 amazing pitches, but which one was the best? I will give you 1 minute to vote before announcing the winner. In the meantime, if you are interested in corporate innovation as much as we are, we have some upcoming events from our Munich team you might like. Let's watch it on the video. And the winner is Fahd. Congratulations, guys. The winner will be awarded with the exclusive mentorship session with Plug and Play, which will kick off in the first week of February. Congratulations again. Great pitch. See you there.
Now, welcome back, everybody. Congratulations to Sören from Hamburg, from Etwas. Congratulations on the prize going to my hometown. I'm very proud, and we have some first-hand pictures from Sören celebrating. It's a bit bright. We pull brightness a bit down, and we see it again. There he is. Yay! Congratulations once again, and of course, thank you very much, Anna, for presenting the startups. Now, if you want to go speak with the founders of those startups, please join them in the expo section, where each of them will have their own booth. And they will be there for, well, the next 30 to 60 minutes. Now, let's continue with the next panel here, called Digital Assets and Tokenization, more than just crypto and NFTs. Now, digital assets have been widely discussed in the public discourse since the start of the pandemic, with crypto reaching new highs and NFTs becoming increasingly popular. However, large financial institutions are also getting increasingly active in the space. Now, let's hear what regulatory challenges still remain and where the priorities lie for the future. The panel will be hosted by Maximilian Jungreis, crypto lead at Plug and Play Ventures, and he'll be joined by Vinoy Kumar, digital assets expert, Dotun Rominiji, blockchain strategy and emerging technology at London Stock Exchange Group, Francisco Maroto, head of blockchain and digital assets at BBVA. Take it away. Well, if all of the 4 gentlemen are there, take it away, gentlemen.
Hi, everyone. Thank you very much for joining us today. We're really excited to have this very timely discussion around digital assets and tokenization. So here at Plug and Play, we have a very diverse audience from different industries, different companies, and different sectors. So maybe just to set the foreground, if we could go through a brief introduction on asset tokenization, maybe an explanation on the different components and why this area is so exciting. So I'll hand that over to Francisco.
So thank you so much. It's a pleasure being here with you today. I think I will start by explaining the most basic thing, in tokenization, which is a token. What is a token? Well, a token is nothing more than a digital representation of an asset. Typically, the token does not have any intrinsic value by itself, but it is linked to an underlying asset, and this asset can have value. This asset can be a real asset, such as gold or real estate, or it can be a virtual asset, such as a cryptocurrency, a basket of cryptocurrencies, or a song, or a digital work of art, such as the case of the NFTs, non-fungible tokens that we are seeing so much in the last weeks and months. And what is tokenization? Well, tokenization is the issuance, the creation of these tokens. It's the process of creating a unique digital representation of an asset. And why do we do this? Why do we represent digitally an asset? Well, because it enables the trading, storage, and transfer in this new digital world that is emerging now. And this brings benefits. It can bring benefits. So what are the key benefits that we see by using tokenization of assets? Well, in first place, we are using blockchain technology. We are building on top of blockchain networks, and these blockchain networks are working normally 24 hours a day, 7 days a week, 365 days a year. So they are always working and are enabling this issuance, this storage, and this transfer during all the time of the day and during all the year. And this is quite a change when comparing to traditional markets where you have operating hours and some closures from some days. It can also bring what blockchain technology brings by itself. No, the technology itself enables this transfer of assets and this ownership of the asset in a very secure and traceable way. So you can do all these operations of trading and transferring these assets in a secure manner, in a traceable manner, thanks to blockchain. And by working all the different stakeholders in the asset management process, from pre-trade to post-trade, the traders, the buyers, the sellers, the custodians, they are all working on top of the same platform, on the same ecosystem, and this can bring operational efficiency. You can remove intermediaries or potentially remove intermediaries, and you could also reduce the number of reconciliation processes that are always involved in this type of asset management and asset exchange processes. Asset tokenization can also bring the possibility of asset fractionality. So you can buy, for example, a painting and issue 1,000 tokens or 1 billion tokens that represent the ownership or the property of this painting or this asset. No? You can also enable the connection of regulators directly to the blockchain, and they could be able to see what's going on this trading venue, on this market, enabling a better compliance, automated reporting, and also the programmability of the tokens. And by representing the token in the blockchain, you can program certain things such as limits that enable that you are complying with the laws or with your requirements as a company. And finally, tokenization also brings the possibility of opening the issuance and transfer of this asset or this digital asset to anyone in the world in a seamless and easy way. And we have seen this with Bitcoin and ETH, that anyone can access and buy and sell and trade this type of crypto assets. No? So it's also relevant to understand that there are different types of tokens, and there are different ways of classifying tokens. No? We can classify them by functionality, and here we find payment tokens such as Bitcoin. Bitcoin is a payment token, which is a new means of payment or an alternative means of payment, although now it's more used for value, for storage of value rather than as a means of payment, but it was born for this use. Ethereum also can be considered a payment token, and the following type of tokens, depending on functionality, would be utility tokens. So in this case, it's not a means of payment; it would be a payment or a user token or an app coin that enables future access to the products or services offered by a company. And here we have tokens that enable you to access to services such as storage on the cloud, or maybe a discount when trading crypto assets. An example of this would be Ethereum again. Ethereum can be a payment token and can be a utility token when you develop a smart contract or use a decentralized app on top of Ethereum network, you need to pay gas. When you are paying gas, you are using Ethereum as a utility token. And finally, we have asset-backed tokens. And these asset-backed tokens, as I mentioned before, you can have real assets represented digitally, real estate, gold, or you can have digital assets which are issued, stored, and transferred in a tokenized format. And here in this space, we can find financial assets that, if they are subject to securities laws, can be considered as a security token. And if you can have non-financial assets that don't have to comply with these securities laws. And finally, it would be interesting to note that we can have security tokens representing physical securities. So we have the traditional security, we represent it digitally with a token, and we have security tokens. Okay? And then, if regulation allows it, we can have natively issued security tokens or securities, or natively issued digital assets. And this is the most interesting use case, because we are removing the old world from the equation. It enables the financial industry to work directly with native digital assets. No? And here's where we see more potential for tokenization, and where we can see a more advance in the future. No? But for this, again, we need that regulation enables it, and we are seeing some movements in this direction. For example, in Germany, with the law around special bonds, a type of bond, a small amount, that now can be directly issued in a blockchain, and it would be a native digital security, where you don't need all the old legacy procedures and processes, no? And you can work directly with the token in the network. And finally, to complete the photograph, we can also tokenize cash. So when we are talking of trading and storing and transferring digital assets, it's really important to also have the cash leg to be able to do the settlement of this transfer of assets. And that's why it's also relevant to have a stable coin or a CBDC, a central bank digital currency, that enables you to work with both the digital asset and the digital cash on the same platform, on the same system, and do all the exchange and all the delivery versus payment on the same platform, on the same network. And there are different ways also of classifying the tokens, different types of tokens. You can classify them by the technical standard. And we have ERC20s, ERC2721s, different standards and formats for the different uses of these tokens. And depending on the network where you are issuing these tokens, on the blockchain where you want to issue these tokens, you might use one technical standard or the other. And so, yeah, I think that's a high-level introduction of tokenization and the tokenized world. I think I have covered quite a few things. I invite my fellow panelists to add anything if they think I have left something.
I think Francisco has covered quite a lot of the basic concepts. So, Maxim, I'm sure you have other questions.
Yeah, and Francisco, you did a really great job of kind of exploring this crash course introduction to asset tokenization. It's so multifaceted, and there's very many moving pieces and different types of asset tokenization forms. So thank you very much for the high level picture and color on the current processes and how they're working with financial institutions. You mentioned a key point there, which was regarding regulation. Regulators are looking at this market in very many different ways and through different scopes. I'd like to switch the conversation over to regulation. So this question is for Vinoy. How is this regulatory landscape accelerating or hindering the adoption of asset tokenization and digital assets through this corporate lens? Would love to also learn maybe more about some pilots that banks are following closely to assess and to assist in charting their own strategy forward.
Thanks for that, Maximo. A very broad range of broad scope. So maybe just indulge me a little bit and just bear with me while I paint the picture a little bit. And I'll try and build on what Francesco was saying. Yeah, I think the construct he explained very well, so I will not go there. But what it is like he alluded, the utilization or the development you could see along several vectors of this technology or this construct, right? So one he touched upon was digitalization of commerce and economies and the finer frontier of money being tokenized, right? So it's finally money is moving into the new age of innovation and a new age, you could say. Web 3.0, which we often talk about, that's the other vector, and the Web 3.0 metaverse is going to be out there, and we'll hear a lot about that. Tokenization of assets, of course, improves the liquidity profile, democratization of ownership, which Francesco touched upon, creation of alternate financial systems, BDC, etc. I mean, I think, there are people who don't believe in the existing financial systems anymore for various reasons. And of course, there's a lot of work which is going on at the protocol level as well, addressing some of the basic challenges or basic technology aspects of this. So there's a bunch of stuff which is happening, right? If you put the enterprise lens, it's getting very exciting. There was a time when you could say that, okay, is this something which is a blip, or is this something which is going to last? And you can see a lot more activity. The corporates which are looking at treasury investments, payments, the marketplaces and community is looking at unlocking value in the client base using tokens or stablecoins. Like Francesco was saying, some of the real estate players or commercial real estate players looking at tokenization to raise capital to improve liquidity of the asset books. And there's an increasing interest, therefore, in the asset management sector as well, both as an asset class as well as opportunity to improve the efficiency of the sector. And of course, what this also means, as you know, there's emergence of new crypto-native players. Example, centralized exchanges, many of which are now seeking the regulated path forward. Right. And by the way, so I've talked about the enterprise lens, and I've talked about the players which are much more in sort of a closer to the regulated space. There's a whole bunch of DeFi models, which is a completely different ballgame. And the reason why I focus on the regulated sector, because that naturally leads to the other aspect of the banks, which are very important from the integration of the technology or so on, or the developments into the existing financial systems. And banks are typically authorized, or they are authorized entities and gatekeepers to financial systems, right? So they have to operate in a manner which is responsible, regulated, and from a conduct perspective, et cetera, et cetera. And you were spot on in the question, is that the regulatory framework has a huge implication for this, because if from directly or indirectly, banks affect other corporates and entities and the services that they use or they're provided. And the landscape is quite complex, and it's not. It's to be expected, right? It's a fundamental transformation which is taking place. It's something new which is coming into place, which is quite foundational and broad-ranging, touching almost every aspect of financial services or economies, etc. And this is something new. So there are several gaps. At the highest level, if you look at what should be the regulatory framework around stable coins or tokens, et cetera, this is a big question, right, which is to be addressed. There, if you look at from a specific case of tokenization, in case of assets, as Francesco touched upon this, there's inconsistent recognition of digital representation, and whether it's a financial security or not across jurisdictions. There's still requirements of keeping physical forms of documentation or otherwise, or some keeping records, wet signatures, all of these. I mean, these need to be sorted, or these are some of the impediments which you talk about, right? There are still concerns with AML, CFTs, and financial crime risks, which are of concern to regulators and even industry operators. And the other interesting thing, which, as we all know, is that because there's so many different sectors which are involved, therefore there are different regulatory frameworks, etc., which need to be dealt with. And there are different sectors and jurisdictions which are evolving at a different pace. And there's a lot of inconsistency, even in nomenclature, in taxonomy and everything else. You see a lot of inconsistency. But it's not all bad news, because I think, this is why I started by saying that how much activity is going on. So while it should not be seen that this is a massive impediment, in a way it is, but in a way it is also setting up the place. It is on the notice of the regulators, or they have, and so they have been, and don't envy their task, because if they move too fast, they put the financial system at risk, and if they move too slow, they put the innovation at risk. So yeah, it's a tough ask, right? But the good news is that there are regulatory and legal framework changes and consultations underway. So we know that, for example, if you look at Europe, MiCA is very much on the radar. If you look at more broadly, stablecoin regulatory framework is in discussion in several jurisdictions, and while several of them are coming from different angles, but there's also degrees of consistency between them. BCBS consultation is going to be quite important, and there's some results, and there's some very, very tangible efforts being made. Francesco alluded to one of them. The France, passing a law that allows registration of digital securities and for them to be recognized as financial securities is quite important one. So there's some good news as well, right? And so I would say that if you look at regulations are going to dictate the pace, and this is something which is to be right, but the trajectory is positive, and there's a lot of movement on this. If you look at it from a bank's perspective in this framework, like I said, banks have to operate within the regulated parameters and everything else. I would say that their focus naturally is much more on set aspects of the industry, which is more regulated space or regulator friendly. So you see a lot of attention being posed on trading, risk management, investment side of things, because there's a natural demand starting to come from institutional. Initially, crypto was much more retail activity, but we are seeing more and more institutional activity coming in there. So there's that one. Payments, we're seeing payments as one of the major areas which is expected to be disrupted, especially given the inefficiency which exists in cross-border payments, right? So we are seeing quite a few initiatives, even from BIS, which is there on the radar. CBDCs is, of course, falls into that as well. If you look at further from there, tokenization is the other aspect which is there. There are custody and basic core infrastructure, etc., which are being looked at. So in short, I mean, I think there is a lot of activity which is being looked at from banks or within the banking space, and some of them are even interestingly dabbling into DeFi space. You would have seen the news of the bond tokens being used as collateral on MakerDAO. So that I thought was a very, very interesting foray in there. So it's all positive. I would say it's you could have lots of questions and everything else, but there's a much more broad-based and I would say direction in a positive way. That's where it is going.
Yeah, and I think you touched on this idea that regulators are learning almost at the same speed as technologists, as banks, in terms of the full capability and capacity of these systems. So obviously there are some growing pains with an industry that moves, lightning fast. It feels like one day or 1 week in crypto is 10x the amount of time it takes with traditional financial markets. So we're seeing a lot of really interesting ideas that are arising around regulation And I guess you touched on one area that I think is really interesting. You mentioned, DLT and digital assets enabling public market capital raising solutions that are unlike today's current solutions. That's one of the really innovative forefront ideas. And I'd love to hear from Dotun and what are some key trends that you're seeing in existing markets and new markets as a financial infrastructure provider like yourselves at the London Stock Exchange Group. Where do you kind of envision this new paradigm, and how do you see the different market actors?
I think it's a great question. and I think a lot of it actually chimes back with some of the points that Vinoy and Francesco have already made. But I think starting with grassroots, if you look at the kind of public markets landscape today, we typically serve very, very large organizations that are looking to move from that next stage of transition from kind of private through IPO and then onto the public sphere. And I think there's a certain level of weight in terms of kind of disclosure requirements, in terms of governance requirements that these organizations need to maintain. And then there's the kind of obvious aspect of giving up some level of control over, the governance of an organization when you make, a lot of the stock public, that have over the years kind of tapered off a lot of interest from growth stage firms really looking to raise capital to essentially make that transition maybe at an earlier point in their life cycle. I think one of the very interesting aspects of DLT as a technology is it enables us to build a future landscape whereby you can create much more continuum in terms of being able to serve these companies. And actually you can almost in a sense virtualize that journey, whereby it becomes a digitization on the front end in the initial issuance of the company and the emergence of the company. And then you can provide access to capital raising through different spheres. You can provide, the settlement infrastructure to allow, kind of equities to move around the ecosystem, to allow investors to gain access to these assets. And you can provide compliance rails to enable foreign investment across jurisdictional. You can leverage CBDCs to provide the cash legs for settlement on private transactions too. And you can enable layered services via smart contracts to provision proxy voting and cash flow distributions around these assets. So for example, coupon payments for bond instruments or, dividends for equities and the like. And over time, you enable this kind of growth, really this kind of growth and development of capabilities to really evolve with these organizations as they develop. I think what's interesting is in the public sphere, and I think one of the challenges that we have when we look at kind of the utility of DLT in terms of as a transformational technology in that space is, trading in itself as a function, multilateral trading as a function, doesn't really change in a world of DLT. And we can see that confidently, specifically when we look at a lot of the innovations in the unregulated space, in the crypto space. What we see is a landscape whereby, a lot of the change and evolution is largely driven predominantly by innovation and what's the best solution to solve the problem. And in that world, the overwhelming majority of turnover in terms of trading is still happening in centralized venues. So clearly there's an economies of scale proposition. There's an economic value in having that convened and aggregated liquidity in a centralized venue that you just can't beat. Obviously, we know that there are latency constraints that DLT imposes around how fast your throughput can be and how narrow your latencies can get in terms of transaction confirmations. But at the same time, you can have this seamless model whereby, as you see in the crypto space, you have a trading venue that operates both kind of trading, but also provides settlement, provides custody, and it's a much more holistic service. It provides direct access all the way down to the investors. And I think longer term, what we'll start to see is models that really start to bring a level of emulation around that. I think the challenges that we see across the landscape today are largely, as Vinoy pointed out, there are regulatory realities that we do need to grapple with. We can't just put settlement, for example, post-trade settlement on DLT because, there are regimes that are in place across Europe and the UK and the US, CSDR being a perfect example, USRs in the UK, that really are framed in a way where there's an expectation that there is an authorized entity that performs certain roles, and delivery versus payment in terms of settlement being one of them. So what you need is a landscape whereby we can leverage the technology to enable these entities to perform those roles, but largely automate those workflows where the authorized activity is still in place, but the provision of that and the marginal cost of that activity becomes so minimal that it almost becomes transparent to the workflow. And I think that's where we're going to move to. And I think over time that will enable regulators to get much more comfortable with the technology, with seeing it operate in large kind of liquid markets, large systemically important markets, and we trade over $1 trillion worth of equities annually on our markets. If we can see DLT supporting that scale of infrastructure, systemically important infrastructure, I think that gives regulators a lot more confidence to say, this is a technology we see can be positioned for the future. This is a technology that we can see can fulfill certain roles whereby traditionally we required intermediaries to fulfill them, and maybe that we'll start to see more of a gradual evolution of some of these trends. But I think most importantly, and going back to the regulation point, regulators have a mandate to ensure market stability, investors are protected, and we have full transparency across the board and can ensure that there's a level playing field. And I think that's something that we obviously have to take very seriously in the regulated space. On the crypto side, we've seen successes and failures on every side of that, right? And so I think that there are variations in terms of how fast we can move, but there is still a lot that we can do and a lot that we are doing today.
Yeah, and I think staying in that same vein, how far away do you believe the major banks are in implementing these digital asset solutions, and maybe where do you see the beachhead, whether it's custody, the retail side, which Vinoy touched on, capital markets. Vinoy, I'll hand that one to you.
Thanks for that, Maxime. I was just looking to unmute my microphone, so sorry for a bit of delay. Yeah, I mean, the honest answer is that it's very exciting, but it's nowhere close to any level of maturity as yet, right? I mean, I think we just have to be really honest about this. And in a way, that is what is important. That's an important one, because what it means that everyone has to be very agile and accommodative and be on the lookout for the changes that will happen, because I don't think anyone has a crystal ball which can accurately predict where it will go. And there's so many different directions, and like I was saying, the vectors in which it can grow, and they will all impact each other. So if you look in that kind of context, the banks, there's some who have made more commitment than the others, and there's some who are watching it very closely. And also you have to recognize that bank as a term, it is quite a broad-ranging set of players in there. There are global majors, there are regionals, locals, all of that stuff. So they all have different, I would say, lens on these things. But I would say that those that are participating or have committed to the space are looking at this, the areas which we have touched upon. I mean, I think investments, trading, risk management is an area where lots of banks are looking at. They are very much also cognizant of the issues that Dotun was touching upon. I mean, that's very much on the radar as to what the future market infrastructures, etc., will look like. So watching very closely at that. Payments, I mean, I think payments is a reality, especially for markets which are closer to CBDC. They may not be an option. So I think that's something which is, is looking at. If you look at tokenization, I would say tokenization is very much on the radar. But I would say, and I'll touch on, I mean, tokenization, because of the regulatory or some issues we touched upon, in some ways that is proving to be a slower moving and much more at the experimentation and pilot stage than a reality at this stage, right? I mean, I think you're seeing tokenization in some way more in the unregulated space or DeFi space than in the regulated space kind of thing, because of regulatory sort of things. The other interesting thing is that, not surprisingly, the banks, etc., are looking at the risk and compliance frameworks and the risk appetites, etc., very, very closely, because them being regulated and there's so much of regulatory scrutiny and attention on this as well. I would say the other interesting which often gets missed is they're also trying to figure it out as to how to respond to this from an organizational construct. And you notice a spectrum of models by which banks are trying to respond to this. Some have set up business units, some have set up within the businesses, some are dealing it out of the ventures. So they're still trying to figure it out. So I would say that I think the initial phase of cynicism is giving way to much more saying, okay, there is something happening here. We do need to pay attention to this. Let's figure out how we're going to respond to this and which parts do we participate in, right? And I think if you look at from a beachhead perspective, your point is very valid. Custody, if you look at custody, is a core infrastructure. If you want to participate in this, you have to have some sort of a custody solution. Whether you have it in-house or whether you have a custodial arrangement, that's a matter of discussion, and different organizations are landing a different solution set on this, which is fine, right? But I think that it's given that it's like the digital asset custody is like the bank world, and carries a very, very different sort of risk. Similarly, I would say payments, investments, and risk management are basic activities which are on the radar, and that has to be done. Like I was saying, tokenization. Interestingly, if I were to drag the DeFi into this, I have a strange hypothesis, which is that NFTs might actually drive tokenization rather than the other way around. Because NFTs might catch much faster than the security side of things, kind of, right? And the property rights, etc., we'll see more in the NFT format, and the experimentations, etc., which will actually might trigger this. And in terms of segments, I think, given that there's so much sensitivity about on the regulated side of things, or from a responsibility and consumer protection and conduct, etc. While retail was the starting point for all the crypto activity, and there's a lot of more activity, but it's now the institutional side which you see much more activity in, right? So I mean, I think hopefully that gives you a feel of
and this is a topic that could go on for way longer than the allotted slot we have. But thank you so much to all the panelists. We had a great chat, and this is something that is hopefully very, very eye-opening for a lot of the banks and financial services folks on the line. If you're interested in this topic, feel free to reach out to any of the panelists, myself at Plug and Play, and we'd love to continue the conversation. So thank you so much, everyone, for joining this morning, or this afternoon, I should say.
Thank you very much, everybody in the panel. Thank you to our panelists. And dear audience, if you now have any questions, you may join the Q&A session. If you're watching us on Hopin, just on the left-hand side, you can join the Q&A and ask your questions if you may have any. Now, please join us now for a fireside chat between Stefano Frascani, Head of Group Digital Foresight at Unicredit. He actually joined Unicredit in 2019 as Head of ICTWEU Transformation, Innovation and Design from JP Morgan Chase & Co., where he was the Global Head of Practice Development of Global Market Infrastructure within CIB. And we'll have Saeed Amidi, founder and CEO of Plug and Play. Now, Saeed founded Plug and Play, the ultimate innovation platform, in 2006. He is a technology investor, serial entrepreneur, and seasoned executive with over 30 years of experience in founding, operating, and growing successful companies, as well as investing in early-stage startups. Welcome, Stefano, and welcome, Saeed.
Stefano, it is great seeing you again on this crazy computer screen. It was wonderful seeing you in Italy 2-3 months ago at Turin. It was one of the last exciting trips I had, and it was a pleasure meeting you in person. And I very much welcome you to this chat we're going to have together.
Thank you very much, Saeed. I really appreciate the time. It was exactly the same feeling for me. Attending that session in Turin was probably the last public event we came to. I'm truly excited to speak to you today for several reasons, because I enjoy the conversation with yourself personally, but also given the relationship we have with Plug and Play from a partnership perspective. So very happy and grateful to be here.
I am excited to talk about the first .com bubble and now this crazy valuation. But I wanted to kind of ask you from, JP Morgan to UBS, and now Unicredit. these giant companies and banks and financial institutions, how much in your position do they have a challenge of digital transformation and innovation? And do you think startups can play a part in their digital transformation of these large institutions?
No, I totally think so. So I think there are several players in the financial sector, larger and smaller. But I think some look at what happens in the market from a fintech perspective, and let's say the disruption as opportunity, because they see the competition to come from there as an opportunity to really accelerate their strategy. When it comes to Unicredit, which is the place where I work for, first and foremost, we have changed and really refocus our if you like, attention towards the digital and data world. And we have announced that as part of our strategy a month ago. Therefore, our ambition is really to become a reference bank in Europe. But to do that, we're going to be centered around clients, of course, and product offering to clients with the aid of digitization and data at the center of that. So to answer your question, we look at fintechs and opportunity coming from the market as ways to accelerate our strategy as much as possible, you know. Now, I distinguish between fintechs in terms of solution like assets that we can take into consideration to complement our offering when it comes to products, but also as assets that complement our infrastructure vis-a-vis, let's say, neobanks, as we discussed before, that become competitors to us. Now, all those have a very interesting paradigm when it comes to understanding the offering. Of course, the big advantage towards a giant like ours is the cost-income ratio. You know, the cost is significantly reduced compared to what we have for obvious reasons. You know, we are an incumbent bank. We have our processes. The processes are stratified and developed over a number of years. We have rightly so obligation from a compliance perspective. We are regulated in a certain way. What do we have though that they don't have is the client base. And the client base is something that we consider to be, if you like, our, apart from the capital, of course, our real wealth. And how do we position ourselves there? It's the differentiation factor, if you like.
You know, if I could share with you sort of my thoughts, we kind of, I think Apple doesn't matter if you download like a music or an app, you know, the mobile Apple phone or iPhone. And when you walk into a store of Apple, it is an incredible experience. It's like customer first. The experience is perfect. Doesn't matter if it's in the store or if it's online. And I believe like banks need to serve the customer, perhaps even the Gen Zs, the younger customer, the way they like to be served. And they love to be served online. They love to open a bank account, maybe even make investment decisions, a lot different than in the past. And again, I believe your strategy, Unicredit strategy, to execute faster the digitalization is fantastic. And perhaps these not only fintech company, but the technology companies that are very agile, because before they used to say you don't get fired if you buy IBM or Oracle or SAP.
Yes.
But nowadays, really, you need to be more agile and work with more unique companies, technology companies. Do you think a big organization like yours will work with smaller companies, technology companies?
I think so. I'm actually certain about that. And I'll tell you why, you know. I personally, you touch upon a couple of points that are really very, very relevant for us, including the way of working, you know. So companies like ours are really looking at these times as the opportunity to rethink our position in the marketplace and our branding, our ability to attract talent, our ability to serve our customers. So before I mentioned to you how we want to put the customer at the center, which really means understanding the customer needs during their life cycle, defining the right personas. And there is a difference between an entrepreneur female who has 2 kids and does banking at 9 o'clock because put the kids to bed, and a young entrepreneur who's 27 who wants to make payments during, I don't know, the working hours. So we need to understand how to serve them in a different way, depending on the location, time zone, and so on and so forth. That's from an external perspective. When it comes to the model, internal model, everybody looks at fintechs as an example of how we should operate, adopting agile methodologies to develop software and having tribes that execute on solutions, all right? Now, it's easy to say than to do, because we're a bank. We're a bank with tradition that and people that have been working in a certain way for many years. Now, our strategy is to internalize certain competencies that we don't have because we simply haven't got them. But to be able to do that, and I go back to the core of your question, we're going not only to work with fintechs whenever there is the opportunity, but also look at their model as a way to attract talents. Because we have to be very honest. Right now, you know, the talent pool age is lower and is going to lower again. And we need to adapt to their ability to work at their hours. You know, a developer is somebody who codes at 3 o'clock in the morning. We need to give them this opportunity. We need to give them the environment to be able to do that. We have to create rooms that allow for that type of exchange. Unicredit, with defining those spaces, we have a view on how to create those spaces to be able to facilitate that. Now, when it comes also to work with startups, fintechs, and neobanks, on our side, we have to create the environment from a technology perspective to be able to work in open banking. That's a key requirement, you know, and most banks, including Unicredit, for many years have developed verticals, you know, big monolithic online banking with core banking on the back, core system that are very difficult to break. So some of the shifts that in the market we're observing, and we have started that as well, is to switch from, if you like, a rigid architecture to modular architecture to the implementation of APIs, because they allow us to welcome, if you like, those opportunities for the market and be much more fast. Now, time to market is the other ingredient. The reason why those guys are successful is because they continuously deliver solution in the market. They do simple things, one product at a time, but they evolve that product regularly. We don't have that type of mindset. We have to get there. It's a long journey, but we need to start thinking along the same lines if we want to compete and be competitive.
No, I think what the points you make are incredibly relevant, that the different customers require different offering at different times and different solutions. And if you're smaller, you can react faster. Again, these are America analogies, you know, like Amazon really knows what my wife wants to buy because we have 2-3 boxes a day at our house, and they kind of predict what she's going to like in the future. And again, in financial services, other than banking, the different asset products, different investment scenarios, I think all is going to change with this digitalization. Like the way even people will buy insurance, perhaps.
Absolutely, absolutely. I mean, I think you mentioned before the opportunity to offer customer what they want when they want. Unicredit has around 7.5 to 8 million digital customer. The European customer base, I think, when it comes to digital, and I'm not speaking about financial customer, I speak about digital customer. Again, I don't want to say something factually incorrect, but the last time I checked was around 350 million or something like that. Maybe between 350 to 400 million digital customer. if we want to compete, we're not competing against our peer or against the neobanks. We compete exactly with whomever offers product to digital customer. And this opens up to a new concept which is emerging in the market, which is the concept of ecosystem. Therefore, me as a bank get together with a different players, and is a player that doesn't compete with me on the financial aspect, but offer products that are compatible with my offering. The bank actually should play to its strength, and my strengths are offering payment facilities, offering credit, offering accounts, and so on and so forth, which are my key offerings, if you like. But those coupled with the offering on someone, for instance, that operates in the energy and environment, just to give you an example, and offers the opportunity to renovate products when it comes to reusable energy, allow us to strike new offerings. Okay, you mentioned insurance, for example. That's one that I think is particularly interesting across Europe because it's less developed than I think in North America. But again, that's a sector that we as banks are not particularly active, at least, or are less active than insurance players. There are many opportunities for synergies. And I see this type of trends happening across other industries as well, to be honest.
Wonderful. Again, it's been a great pleasure to talk to you. It's been a great pleasure working with you and your team at Unicredit. And we really look forward to this journey of innovation and digital transformation to kind of navigate it together. And it's been a great pleasure working with you.
No, thank you. I really appreciate the time, the opportunity, the relationship. I truly enjoy the conversation. We're always here, and it's nice to exchange views with you and your team. I'm sure we will continue along those lines in the future as well. You take good care, and I thank the audience as well. Thank you.
Thank you so much. Thank you.
Thank you very much, Stefano. Thank you, Saeed. And we will move on with a short break in just a few moments. Well, in the meantime, you can take the chance to download our future trends report from Plug and Play once again. You see the link down here. Just click it, or we just add it to the chat and you just click it over there. That's how easy it is. And now we'll go into a 5-minute break. Grab yourself a drink, grab yourself a snack, and we'll see you in just a blink of an eye. Did I actually just say we're back after a blink of an eye? I hope you did not blink for 5 minutes, because you've probably been falling asleep by now. I hope not. Welcome back after the break, and we'll continue with the next panel. Now, ensuring that financial products and services not only promote economic prosperity, but equally do not harm the environment is key to sustainable growth. Now, highlighting how a sustainable agenda will transform the banking sector, the following panel, called How the Financial Sector Can Contribute to a More Sustainable Future, will focus on the opportunities sustainable finance brings. The panel will be hosted by Alexandre Morayon. He is principal at Commerz Ventures, and he'll be joined by Julia Menayas, co-founder at Helios, Tatjana Gravenstein, expert for sustainability and strategy at business development at ING, Ina Amesheva, Director of ESG Research and Regulatory Solutions at Arabesque, Eva Meyer, Head of Company Engagement, Sustainable Business, CSR and Foundation at BNP Paribas. And here they are. All right, I can see all of them. Glad you're here. Enjoy your panel.
Great. So good evening, everyone. So a real pleasure to be here surrounded by a remarkable set of panelists, an all-women panel, actually, for once in the industry, I should say, except me as a moderator. Look, I'd like to jump in, actually, on the topic, maybe in a very simple way, right? I'd like to get a rough understanding of how we define sustainability ultimately, right? And if you women allow me, actually, I would like to ask Ina, actually, from the Arabesque angle and the research angle, actually, how do you think about sustainability?
Thanks a lot, Alexandra, and it's really great to be here. Well, as we all know, the term ESG, I think we've probably all of us have heard that term already. ESG stands for Environmental Social Governance. But actually, when you look under the hood of ESG, it's full of a lot of open-ended definitions. So there's no standardized way that actors are looking at ESG. So it can mean different things to different people, depending on the use case and depending on actually how we are integrating sustainability, be it in investment decisions, in risk management, in compliance, reporting, and so forth. The field is still full of a lot of technicalities and jargon with uncertain definitions around emissions, scopes, biodiversity, different fields of reporting along all the three dimensions of ESG. So in short, we don't really have a definition, and that's actually a problem that the industry is now trying to solve, and also regulators are trying to solve. But I think we can dive a bit into this topic a bit later in the panel. So yeah, we're dealing with a lot of complexity around sustainability, and I think that's one of the key challenges and also opportunities that we are dealing with.
Well, that's yeah, it is indeed a new era and a whole new domain of finance we're looking at. And I think one person that might enlighten us actually on how the existing industry thinks of sustainability would be Tatjana, for example, from the ING perspective.
Yes, thank you very much also for having me here. I'm very, very happy to be here. And our sustainability direction actually is based on the following questions. We ask ourselves, where can we as a bank make the biggest impact while addressing the biggest challenges? And we believe that is in two areas. First area is the healthy planet, we call it. Climate change is one of the biggest challenges of our time. And we have been using the Terra approach since 2018 to actually steer our portfolio towards global climate goals. And by joining the Net Zero Banking Alliance last year, 2021, we even increased our ambition, meaning we want to steer our portfolio towards 1.5 degrees Celsius and also achieve that by net zero by 2050. Our Terra approach covers 9 most carbon-intensive sectors of our portfolio, such as power generation, automotive, cement, you name it. And what we really believe is that it's very important that we cannot fulfill this challenge alone. So we are always looking for partners and collaboration. And we also believe that it is key to combat climate change, to be very transparent, which is why we also transparently report on our progress with regards to the Terra approach regularly. The second area I was mentioned are prosperous people. So we believe also that we can do something with the financial stress a lot of people around the world are facing, and to help them. So financial health is connected to our physical health and also to social well-being. And we believe that financially healthy people can actually contribute to a healthy economy and help drive social progress. As a bank, money is our core business. And as innovators, we put insights on people and money into products, tools, research and education that help contribute to a financial healthy society. To bring it all together, we want to help create a healthy planet with prosperous people.
Good. Well, at least it's a good direction. I'm actually asking myself, so you mentioned actually very tangible action, right? A Terra approach on the ING side. Eva, what about BNP Paribas? What are the concrete effort that you guys are taking actually to make you or customers actually more sustainable?
Hi, good evening, everyone. So also thank you very much for having me here. Well, we look at 2 dimensions. The one is, of course, what are we doing as a bank or internally as a corporate, meaning what about our own CO2 footprint? How can we reduce paper, plastic, etc.? The second thing is also to, to take part on alliances like the Net Zero Banking Alliance Tatjana just mentioned. We also confirmed to the goals to be net zero until 2050. And the third thing is our sector policies. So we do have a really firm description of 9 sectors, like coal, oil and gas, nuclear, defense, etc., where we have strict guidelines until when we are able to collaborate with corporates and ways we really have to step out of relationship managements or relationships which shall serve as a compass. And what Tatjana said before, like where do we have the biggest impact as a bank, is of course with our clients to enable them to go on a more sustainable path. And therefore, we have special advisory teams. Our group announced last year that we implemented a low carbon transition advisory group. And in Germany, we do have a sustainable advisory and business team. They really serve as specialist center of expertise for internal discussions, but also as experts for clients, because for us it's really important to go in a strategic dialogue with our clients, to understand their pathway, to understand their strategy, and then to really think how can we support them. That can be sustainable finance, but I don't like the word because it's so much more than the finance. It can be finding a good company to acquire, which will be complementary to the products. It can be fleet management. Like there's so many aspects to tackle that we really want to have the entire client approach.
Yeah, excellent. Now, Julia, you're on the opposite side, I would say, in terms of maturity spectrum, in terms of companies, right? You're the new entrant, the challenger. I know you've probably been pitching before and speaking about Helios, but maybe a few words on how you see it actually in terms of concrete efforts.
Yes, so we are the new entrants. We are very young, but launched for a year only. So obviously we don't have the same size of balance sheet as BNP Paribas or ING, for instance. But we exist because of an issue that actually links banks to global warming somehow. So I'm going to take the kind of NGO hat at this point, but the issue that we are tackling here is the fact that banks still invest in fossil fuel related projects. Obviously, those investments are reducing right now, even though numbers are not exactly aligned with what we need to actually align on a plus 1.5 or 2 degrees trajectory. But with Helios, what we are trying to build is first to make sustainable banking available to everyone. So we are talking about topics that are not really available for the retail market at the moment. So our first mission is to make it available for everyone, to make it understandable also for everyone, because the topics that we're actually discussing now are very far away from anyone's actually understanding of the finance and how does it work and what the banks is doing with my money, etc. So we are making it understandable for everyone. And finally, making sure that no money on our accounts is actually fueling global warming or any industry that is related to harming biodiversity or the people on a more large basis.
Good. So look, I think it's interesting because it highlights that there's an element of convergence, obviously, but also an element of how we understand sustainability, right, and how we interpret it, and so the finance at large has been rehashing about ESG rating, ESG criteria, and coherence and standards, right? And we're still at the point where there's an element of convergence, right? But the role is still up in the air. So where do we stand here in terms of ESG? And I don't know, maybe Eva, do you have a comment on
that? Yes, that was pretty well described before. It's very complex. And what I see in the banking sector is that we are still on a learning journey to understand what does it mean, where are the risks, how do I have to approach different sectors. So that is one important thing. And on the other side, you also mentioned it with ESG rating agencies, which came now also into the market. So I think that is helpful because it gives us an understanding that it's not only the normal financial credit risk you have to look at, but we also have to make sure that we understand ESG risks properly. And on the other side, of course, it's the challenge because when you look, for example, at the different ratings, they can differ a lot. You have one company with one sustainable rating agency. The company is really great because the agency looks at the environmental part. Then with the other rating agency, the company can have a really bad result because, for example, governance is more important. So it's not really comparable. And but what we see is that investors, also from the institutional side, but also from the private side, start to look at it more. But when I could make a wish, and I think we're all working on it, it would be good to, to have the data, to understand the data, to understand which key criteria are relevant, and to have it more comparable. But here, there's still a way to go.
I can imagine. There's another standard, I believe, that's drawing itself, right? And I understand from Ina, actually, it's going to weigh a bit, right? I think the EU is setting its own taxonomy there. So is that a big deal?
Exactly. It's on everyone's lips these days, right? The EU taxonomy. So maybe just to build a bit on Eva's point, right? There's a lot of divergence currently on the market of ESG ratings, ESG standards, a lot of incoherence, and it's very difficult to compare the rating of one company compared to another. And that's why the EU has come on board with the EU Green Deal that was announced already back in 2018 with the intention to streamline a little bit what is considered sustainable. And as part of the EU Green Deal, there was also the EU taxonomy, which is essentially a classification system of economic activities that can be considered green under a set of very detailed technical definitions. And why it is a big deal, it's that all large European companies already have to report their levels of taxonomy eligibility already as of this January. So that's one regulation that's already in force, already applicable. And also asset managers that are marketing their products and services in the EU, they also have to report on their levels of taxonomy alignment. So it's really having a lot of cross-border impact. And the fact that it's very detailed and technical, it also means that it requires a level of data disclosure that is currently not available on the market. And this is what something that we see here at Arabesk as a data provider. We do live and breathe ESG data, and we have done our own gap analysis on what is currently available on the EU taxonomy. And unsurprisingly, it is data that is not being reported today by the majority of companies. So we'll only see that level of data availability, comparability grow over time with the EU taxonomy and also other regulations around the world that are following suit from that. So it's quite an exciting and evolving space to be in.
So if I may pick up on that, right, and it's a bit improvised, but who's going to have to scramble with that, right? Regulatory change, disclosure obligation arises, right? Is it going to be a theme for publicly listed companies? Is it going to be a theme for asset managers or something for data providers?
Well, maybe I could start. I think in a nutshell, it's really everyone. Every market player active in the EU would have to start integrating sustainability. So it's becoming not really nice to have anymore. It's really a must-have to integrate sustainability into your strategy, into your process, into your data collection, into your analytics, to be able to future-proof business models for carbon neutral economy. So I think it will really impact the entire ecosystem. Yeah, far-reaching.
Good. Well, I mean, that's okay. That's it's something to keep in mind, or in everyone's mind, I guess, as we enter year 2022. But now, maybe more concretely, right? Let's chat a bit on the opportunities in sustainable finance, right? And I think the first one we think about is on the investment side, right, or the project selection side, or the asset selection side. And I'm tempted to ask Julia, you're on the side of companies that make selections of projects or assets, right, that need to fit some ESG guidelines. So how do you go about it?
So maybe to start with a little story here. So my co-founder actually was working in one of the hedge funds of BNP Paribas Group on the ESG side. So that's kind of relates to it. So we have a very pragmatic approach with Helios. We are a bit, not very aligned with all this, debate around methodology, because we are also thinking that we are losing a lot of precious time here debating again and again on topics that are actually quite straightforward, right? If you look at global warming, we actually know and can identify very easily what are the key sources of global warming, meaning energy, mobility, industry, etc. So you know what kind of sectors we need to address and we need to change to lower their carbon emissions and associated carbon emissions. Yeah. So our pragmatic approach with Helios is really thematical. So we focus on those sectors to identify in companies innovative projects that have a real chance of diminishing the carbon emissions of those sectors or key sectors that are related to global warming. So the thematical approach leads us to invest only in for instance, players and sectors who are driving the ecological transition. So waste treatment, for instance, it can be renewables, it can be thermal renovation, low carbon mobility. We just have invested in the first car manufacturer in France building 100% hydrogen vehicles, for instance. We also have been part of the funding of one solar powerhouse in New Caledonia, part of French territory, for instance. So those are projects and sectors that we are very much sure that they are contributing positively to the ecological transition here.
So a very hands-on, pragmatic, no-nonsense approach, right?
Exactly. So anything that our customers can actually understand as well. So aside from methodology, something that is concrete to their mind.
Yeah, it's very much a challenger approach, right? Let's not waste time actually with the old protocol and the old world. But I think if we look at it from the other side now, let's look at companies that are ESG rated, right? Ina, you spend your time looking at the market and those ratings, right? Do you think they're already well reflected in risk-adjusted pricing or potential return for investors?
I think there are really two sides of the coin here. So on the one hand, we have companies that are publishing sustainability reports, providing different types of data to the market, both financial and now non-financial data. And on the other hand, we have the investors or financial institutions who are looking at adjusting their portfolios to make them more resilient for the long term. So maybe just a story of how Arabesk started. Back in the day, we actually started as an asset manager with the goal of mainstreaming sustainability into the investment process through a quantitative, rules-based and ESG integrated investment strategy. But what we saw is that over time, the data engine that we developed in-house was something that could be actually used by the wider industry. So that's why we opened up our S-Ray product, essentially to allow our clients to also integrate this type of data into their investment process. So I think the motivation behind integrating ESG, first of all, started as maybe let's try to find outperformance or alpha into our investment decisions, but then also evolved into more risk management, into looking at how could we build a more resilient portfolio over time. And there are various studies, of course, that are showing that correlation between an ESG focused portfolio and more stable financial return over time, lower risk, lower volatility, lower cost of capital, and so forth. So there's really incentives on both sides for both companies and financial markets to integrate sustainability into their longer term strategies.
Good. Well, look, at WOM, from the side of France's largest lender, right, but also the European, one of the key, figurehead of lending in Europe, right, Eva, do you think good ESG rating or companies with good ESG rating today that present a good risk profile for investors right off the bat?
I definitely believe that companies with a good ESG strategy represent a good risk return profile for investors. And I think you said that with outperformance and also from a risk perspective. I think several years ago, when you looked at ESG investments or sustainability investments, it was more like, okay, doing something good, but maybe not with the same return. And a lot of studies show that investments with a good ESG background, with a good ESG strategy, are outperforming, do have a better risk profile. So I definitely think that, and that is often also reflected in an ESG rating. But of course, we still have to highlight that so far there's no standard for ESG ratings, and it's not really, it's not really regulated by the authorities. So I think there is some room for improvement, but nevertheless, to look at different ESG ratings and from an investor perspective makes definitely sense.
Yeah. Well, look, let's hope the market didn't get ahead of itself on that one, right? We live in confused times now with the recent correction. So I guess there will be, the judge are still out actually on where we stand. But let's hope indeed those companies are good risk and good long-term picks, whether they're on the debt side or equity side. Now, there's a theme that's closer to my heart, right? Obviously, as a technology investor, we thought about this space quite at length, right? We've one of my colleagues actually, as a German coined climate fintech, I know the German really like to glue their name together. It's a space we've been looking at and investing in. And so I'd like to really pick your brains, right? Do you think, and what role do you think technology has in the financial sector in transitioning towards a more sustainable economy? And frankly, I'd like to ask Julia, as the first tech-driven company here. I mean, all of you are tech-driven, understand me well, but Julia is starting fresh.
Sure. So technology obviously makes solutions available to a more broader audience. So that's how we, approach this issue here. Also, the thing is that the vision that we have is to make sustainable banking, sustainable finance available to everyone. We cannot expect people to make compromises, right? So also through technology, we can offer the best banking experience possible, and thus making ethical banking or sustainable banking available to the mass market. So really breaking the frontiers of ethical banking or sustainable banking that have been there for a long time now. So technology makes it more available for everyone, and that's the mass effect that we need to address global warming at some point. I don't know if that's the answer you're expecting, Alexander.
I mean, in a way, you're saying that technology is providing you the platform and reach actually to enable sustainable finance, right?
Yes, that's exactly it. Also, to technology, we can somehow crowdsource also the change. So let's take an example here with Helios, for instance. We are using technology to make our clients and our community vote for the next project that we should fund. So obviously they're not deciding 100% because the analysis is much more complex than just one vote. But also people and clients of banks become stakeholders and decision makers somehow, and they contribute to the transition. So they are more than clients; they are really players and actors in this transition, and that's super important.
Good. Tatiana, I'd like to hear your view as well on where technology plays in, because ING has been the first digital bank and really crushing it on that front. So you probably have ideas actually ahead of the curve now.
Well, I can only confirm that I believe technology is an enabler. And what we heard during the entire discussion is that we are talking about new data, new KPIs. So we really need technology to support us in sourcing this data, in analyzing this data, in also harmonizing, standardizing KPIs and using this data. So I think it's a key to actually transform and successfully make that transformation. And also, as Julia said, it's very important to actually get that speed in order to not miss the goal we all have. So technology is key.
So data, speed of execution, right, and basically impact augmentation, right? Ina, you're coming from an angle that's fundamentally tech-driven, so you probably have a comment here as well.
I actually wanted to add a shameless plug in the last minute. It's about actually we launched a data platform on the 1st of December called ESG Book, and this is essentially intending to solve all the challenges we just discussed. We are making publicly available all the ESG data submitted by the world's largest publicly listed companies. We'll be providing analytics on the platform and also the opportunity to streamline and harmonize different reporting standards and frameworks from around the world, including GRI, SASB, SFDR, the EU taxonomy. So essentially we are making a translation tool to help people navigate this growing maze of standards and frameworks. So if you'd like to take a look, it's publicly accessible and free, esgbook.com. If you like to, this platform is already out there.
Excellent. So if I'm not wrong, we should be right at the end of time. So if I get the option, I'd like to ask Eva if she has an added view on that. Otherwise, you'll have to cut me out.
Just can confirm it, data, data, data. That's the most important point from a technological view.
All right. So let's talk last minute. And I think you're on mute.
The phrase of the year, isn't it?
At least I see a very elegant.
Any. And we are almost at the end of the first day of our Fintech and Enterprise Tech Europe 2022. But before finishing, we have one great panel ahead of us. Now, the services that banks offer to their clients are always evolving. So the underlying infrastructure needs to be adapted constantly to provide the best possible customer experience and performance. The title of the panel, Banking Infrastructure. What do banks need to be future-proof, need to do to be future-proof? The panel will be hosted by Gil Cohen, Vice President EMEA at Open Legacy. And he'll be joined by Dr. Chadi Suleiman, Head of Core Banking Systems at Raiffeisen Bank International AG. Ove Cresson, Co-founder and CTO at TOOM. Shuki Licht, Senior Vice President and Chief Innovation Officer at Finastra. Jack Cooper-McEvan, EMEA Head of Data Science Global Technology Infrastructure at JP Morgan Chase & Co. And here they are. I can see all of them, such beautiful faces to end the first day with, and the stage is yours.
Hi, everyone. So welcome to the banking infrastructure, and we have an exciting discussion. I wanted to start and share some, at least the research that I've seen from Gartner recently, where Gartner interviewed about 50 plus CIOs talking about their infrastructure, talking about the challenges around the pandemic, and then they asked them, what is actually the biggest challenge that you experienced in the last 2 years? And we heard a lot of different answers, from operational excellence to reducing cost, but the number one thing was really, it's all about speed and time to market. So I'm really interested to actually get your thoughts first about what do you think the CIO actually biggest challenges these days? So Jack, maybe I'll start with you.
Yeah, sure. I can kick off. Yes. So the biggest challenge, at least what we are facing within and what I've experienced, is complexity. As we've seen, the old days of the monolith is gone. We're now replacing it with microservices, bits of cloud mixed in. We have a front end, a disentangled back end. We're adding complexity into the system at every stage. And with that complexity comes risk, comes a difficulty to manage. And we have to make sure that we can monitor it. We understand that complexity. And when things go wrong, we know how to deal with it.
Excellent. Thank you, Jack. Chadi, what's your view on this?
I think here we have three parameters that we need to consider. The first one is a legacy, and of course, then the underlying complexity of this legacy, especially that this legacy is existing since decades. It's reliable, but it has a certain complexity if you want to initiate any transformation and support move more into the direction of digital services, banking as a service, or banking as or platform as a service. The second parameter is the organizational structure that we have, especially when you are talking about a big bank, existing bank, and the whole transformation to an agile, adaptive, where you have business and IT joining forces together. And the third parameter, and this is a very crucial parameter, is finding the right talents, the right people for this kind of transformation and digitalization. And this is, I think, a parameter which heavily impact on the other two parameters.
Yeah. Absolutely agree, and especially about the collaboration between business and IT, it's always been a challenge. Shuki, from your perspective, what would you say are the top challenges?
So, with discussion, and we are discussing as Finasta with lots of customers, the main challenge for them is to design the strategy and execute a digital transformation. There is still a confusion in the market about what it means, digital transformation, how to prioritize that. And we see, a bank that starting first with the cloud enablement, some others starting first with APIs and open the legacy solution. Some others going first to the user experience and try to build the best user experience and move to a mobile first. The others are just taking AI and data and machine learning and try to bring it in. And now that we are bringing the banking as a service, embedded finance, decentralized finance, and all these start words, the banks are very, very confused about what they need to start first. And I think this is the main challenge. And by helping them to go and select which one they need to do first, what gives them the best priority for them, and also what can generate additional revenue or revenue stream for them will be the key for them to decide what to do first.
Excellent. Agree. Ove, what's your view on this?
Yeah, my view is quite similar to others in a way that I think it's a multi-step thing in reality. That firstly, there is the sort of defining the readiness and what they want to achieve with this transformation in general, that a lot of the banks generally don't do it. It's like, what are you aiming for? Is it cost cutting? Is it future proofing? Are you struggling with launching new businesses at this stage? That what they want to achieve And then you can define that what is the scope of this transformation and how far you are willing to go and what are like the milestones for it. The other part is the sort of how do you handle it when the transformation is ongoing, that how do you share knowledge, how do you collaborate inside the organization, and also that usually what is skipped is that when transformation is ongoing, then a lot of the organizations forget that actually your business is evolving at the same time. So all changes you have to make, is it either organizational or is it technical, you also have to take into account. And finally is, of course, the technical landscape itself, that if you have a lot of different layers, a lot of moving parts there, and it's also changing, then you have to take this into account, and you have to also prepare yourself, as Chadi said, talent-wise, that do you actually have enough talent who can comprehend what is going on and who can participate in changing it.
Yeah, and I think it's definitely can, it's related to the expectations, because the business has a different expectation. I think the customer has a different expectation. People are buying in a different way these days, and but in reality, and especially in this kind of discussion when we're talking about infrastructure, the infrastructure of the bank still there, still exists. I mean, still, we know that everybody's going through a transformation and modernization, but it is hard. It takes time. So, and in the meantime, almost every week you hear about a newcomer that is coming and offering disruptive services. So, as a big bank, I mean, are you looking at it more from an infrastructure point of view, or you're trying to do more things on the front end and trying to adopt as you go? So, Chadi, Raiffeisen is one of the leading banks, so maybe you can give your perspective on that.
I think that the one main driver for us is, for example, the upscaling and downscaling of the whole infrastructure. Yeah, especially in geographies where you have a big customer base, where you need at certain periods of the months, for example, for certain processing reasons, to upscale quickly and then downscale until the next cycle is required. This is one main part. Still, the other thing is how quick you can cope with changes, yeah, and releasing of new product, yeah. When you are dependent on a certain also legacy infrastructure, which restricts your capabilities, yeah, and your flexibility, then this impacts also your speed to market. Yeah.
Yeah. So it's all about adoption, and Jack, maybe it will be good to get your perspective on how you can actually able to do it with the existing infrastructure. And I think also to touch on the point that Chadi made about scaling up and scaling down, because we know if you are successful, and hopefully you are, scaling up can become an issue as well.
Yeah, sure. And doing it with existing infrastructure can be difficult. It can make life easier. Sometimes the hardest thing can be getting the first thing out the door. The hardest thing can be getting the 100th thing out of the door. And I think what you have to look at is sometimes we can use existing infrastructure and we can scale. Sometimes we have to accept that existing infrastructure has got us this far, but the only way to move further is through new infrastructure, whether that's through a build and whether it's kind of going through new infrastructure, or whether it's doing such as what we have done in certain parts of the world, such as Brazil, about through acquisitions and taking in new infrastructure to grow that way. I think it can be a choice either way, but ultimately you have to move with that market. As you talked previously about, do you change the front end? Do you change the back end? If you look at what we've just launched here in the UK with Chase Bank, that is directly competing with all of those new challenger banks. It's fighting them in that space with that digital only brand. And sometimes you have to go where the market's going, but take that, not only that legacy infrastructure that you have behind you, but also the weight and the power that you have, and leverage those tools of security, of safety that you do have as a large bank, and bring those behind you as well.
Yeah, interesting. Maybe Shuki, because you've been, I know Finastra, have been in the market for many years. I mean, you have the kind of the modern stuff, but you still have a lot of clients running on kind of the legacy. Is legacy a negative or actually a positive thing? And how do you actually convince the client that this can be an enabler, or for their growth and for their transformation?
Yeah, thank you, Gil. This is a great question. And let me take you to the process that Finastra went in the last 3 to 4 years when I joined to Finastra. So when I joined to Finastra, we identified that most of our solution is based on a strong legacy system, been consumed by thousands of banks. And we decided instead to go and spend years to try to monetize all the solution, we decided to go take a different approach. First, we opened massively all our core solution with APIs, hundreds of APIs that serving and letting anyone else to come and using our core solution from outside in. Second one, we let the Fintechs community, thousands of Fintechs, we open them and give them access to this API with developer experience, and let them first build and integrate their solution. And second one, let them to innovate on our core solution. So now we are in a situation that we have hundreds of solutions on our very strong and solid legacy, and everything is working together. The third one, we open a marketplace and let the banks to start to consume not only the core solution that's coming from Finastra, but also to augment it with the solution that we bring with the Fintechs. And now you start to have a better and faster enablers for our banks that are using two cores. They have a very fast access with a low cost to integrate and get a high value fintech solution. It also gives them the opportunity to think future with us. So again, we are keeping our, I don't want to call it legacy, but we are keeping our very strong footprints in lending, payment, treasury, capital market, etc., 90% of what the banks need. But on the other side, we give them the connection and the connectivity to the ecosystem. And this is give them the opportunity to work very, very fast and make sure that they are in line about what the expectation of their consumers.
Yeah, fully agree. And the discussion about legacy, is it negative or positive? It's almost a discussion that we have on a daily basis. It's part of our name, but we all want to leave our legacy. But at the end of the day, this is many times where the gold is buried. And the question is, how do you enable the clients to actually expose it, access it, and being able to use it in a digital way? But I think, Ove, I mean, I know that you are also providing kind of the modern approach to banking, and so it will be good to also get your perspective on this.
Yeah, in our case, since we are a relatively late entrant and only like 3.5 years old, then our legacy is, well, very modern legacy in that sense, if you can call it even this way. But I think, well, in our case, it's definitely an enabler, because the roots of Doom are also coming from the fact that all of the founders were actually participating in a lot of different digital transformation and core replacement projects in the past. And their Doom came to be actually that how do you make it simple enough that you could actually do it, and you have something in place instead of sort of that the companies could rather buy than to the building side. In our case, definitely how we also enable it is that since we are using a modern microservices-based architecture, then the main angle of Doom is that how the customers can choose the main business capabilities they need. So that although, yes, we're a core banking vendor, but there are a lot of different modules there. There are lending, payments, card issuing, core banking, deposits, and so forth. So that the customers can actually really choose what they want, so that there is no need to actually bring the whole thing with you and then set it up and configure it and then afterwards maintain it. So this is something that where we stand, and we also have a lot of good feedback on that already, that especially like when there are like companies who already, let's say, have chosen a core, is it Finastra, is it something else, but they want to launch some new business in parallel, something that they didn't buy initially, or they were using their existing solutions. Then, for example, they have used us for lending, some other business areas that they need to have like a quick entry to the market and get themselves up and running.
Excellent. if we're talking about kind of up and running, and if we want to take for a second the discussion to kind of the more hottest trends and what everybody's talking about, how do we actually move to become completely cloud native and using cloud and the best of the cloud. So I'm interested to know if moving into 100% cloud, is that still, you know, a target? Is that a reality, or is that more of a kind of still a dream for an existing bank? So maybe Chadi, let's start with you.
Okay, man. I wanted to comment the last answers and your question in order to step into this and answering this one. I think it's very dependent on the type of transformation you decide, especially when you talk now about an existing bank on the market. Yeah, and here we need to differentiate between two types of transformations: the transformation where we are step by step and maybe capability by capability transforming the bank into the digital era, and in this case also on the cloud. And the other type of transformation is where you start from a greenfield situation, because here you are not tied to the overall legacy that you have in the existing core banking landscape. And there's an underlying fact here. I think we need to think also about a target landscape. And when I go down to core banking, this is where we move in direction of making the core leaner and moving the capabilities into product factories. And this allows us then in the future, to combine also our product portfolio, because I can take the core from Finastra, but I can still take the lending from TUM, or vice versa. Depends on the evolution and on the roadmap of the landscape. However, we think that cloud first is something that we consider when we look at any solution we want to transform or any new solution we would like to introduce. Still looking at the same time with another eye at the local regulator. When we are in the CE region, and the regulator point of view regarding cloud-based solutions or SaaS solutions is different from country to country. There are still some regulators who are very conservative about this, and they expect that your solutions are still either on-prem or maybe in best case in a private cloud inside the banking group itself. And here it makes the thing a bit more complicated versus other countries where it's where the regulator is more open for this kind of solutions, and here we try to move directly into a cloud-based solution. At the end of the day, in the cloud is super and nice, but also you need the TCO behind it. And this depends, of course, on many other parameters that we need to consider. Just to move to cloud only for the sake of moving to cloud and making everything more expensive, this is something that needs to be TCO-wise then, let's say, verified and validated.
No, thank you, Chadi, and I think you touched on a very important point. I mean, there is a IT wish of moving to the cloud. Obviously, there are a lot of benefits around it with the scale and cost and everything, but there is the reality of the regulator, which is not always easy to work with. Jake, maybe what's your, I mean, you're working for a global bank, so what's your take on that in terms of also, if you can touch also the regulator, part on this?
Yeah, so we have a fairly well-documented hybrid-based approach to the cloud. The cloud is great for some things, not great for everything. Our internal cloud is also great for lots of things, and the right balance is a hybrid approach. And one thing that's worth remembering is the cloud is ultimately someone else's computer. Like the places that we're working with, the places that we're talking about the cloud, these people are looking at getting into this banking world as well. And we have to be aware of, do we solely tie ourselves to somewhere that may one day be a competitor? I think we have chosen a multi-tenant, multi-host based approach, which I think is the right approach for various reasons. And the cloud should always be, we should always use the right tool for the right problem. In some cases, that is using the cloud. In some cases, it's using a particular provider, and in some cases it's keeping things on premises, whether that's for regulatory reasons, security reasons, or whatever else it might be.
Yeah, fully agree that I guess the key word is hybrid. But Shuki or Ove, any comments to what we've heard?
Yeah, I agree with all the team, especially what Chadi mentioned, that we will see things that make sense to move to the cloud and things that are less makes to move to the cloud. And I think banks that will select consistently and decide which one will move to the cloud, it will more make sense and they can do it much faster, all the modernization journey. I can give 3 examples, okay? Things around data and analytics, 100% need to move to the cloud. Okay, we decided Finasta, for example, to build end-to-end cloud enablers, everything pre-integrated in the cloud. This is help us first to bring customers very quickly to the cloud with their data journey, and second one, we can inject very quickly AI and machine learning capabilities because you are sitting on very, very modern infrastructure. So, and we are getting a good demand from our customer. Another example is our solution for mortgages. Okay, we are running mortgages today for thousands of banks in the US, and it's much more makes sense to create it as a SaaS solution because in the end of the day, the bank just taking our solution, 3 clicks, and he have it that as a white label into his own bank ecosystem. This makes sense to create it as a cloud solution, things around core system, etc., etc. On the other side, there are areas that you say, hey, with all the respect, because regulator perspective, because privacy perspective, because things that you want to keep the processing run inside the private environment. I don't say that it will not go to the cloud in the future, but it's something that if I was in the bank, I would take it as a lower priority. So as I mentioned, things around core, things around digital front end, things around data and AI, things around SaaS solution like mortgage, etc. The banks have today can feel very comfortable to move it as quick as you can to the cloud.
Okay, great. So I think I hear that we don't think that in 3 to 5 years everybody is going to be 100% cloud. You know, there is a reality that you know, and just like you said, I fully agree that a few things can move to the cloud and should move to the cloud, but some are not. Ove, any other points on this, or?
I have to agree on the part that the hybrid cloud will definitely be the choice, and this is even due to the, as Chadi mentioned, also the regulation that especially that even in some regions you don't have cloud providers, especially in certain specific states. And this is something that, like, for example, Doom has also taken into account that we are cloud agnostic with the capability to actually deploy it on-prem as well. If you look at, for example, Saudi Arabia, then you have only Oracle Cloud. If you look at some other countries, you have different clouds or clouds running a local telcos, then you have to take it account as part of your business.
Okay. We are running close to the end. I want to leave everyone with the last question. I think we all hear, and I listened to some of the previous sessions, everybody's talking about kind of the hottest trends in the, especially when they're talking about the digital initiatives and all the innovative services and things like buy now, pay later, and banking as a service. I think where, you know, Shuki, you mentioned it with your FFTC and you know, value-added services, the sustainability. These things, you know, I want to hear your view on what is the impact on the infrastructure and what do you think will be actually the hottest trend. So if we'll go around the table very quickly, what do you think will be the hottest trend this year? So Jack, maybe you start with you.
Yeah, sure. So I think so obviously I come from an AI and machine learning background, so I am almost obligated to say AI and machine learning. But I think that comes in 2 different flavors. One flavor is on the infrastructure itself, and that's where me and my team focus, and that is we will at some point soon get to the mythical self-healing system across the world and across various banks, where we are able to monitor in real time, to learn these systems, and to just fix every single system. And so we never see systems going wrong, we never see faults happening, and we have these reactive learning systems that are able to constantly react to their environment. The second thing that we're seeing increasingly, we've seen it for a while, is leveraging all this data as banks, as companies, that we that we have about our customers, about users, about the world, and to move from personalization to individualization, to being very specific. Hey, I know you, I understand your profile, and here are the kind of things we can offer you. Here are the tailor-made solutions, the tailor-made experience that is really going to help improve your life and creating that custom experience that every user benefits from.
So machine learning, AI, know your customer better, data. Chadi, what's your kind of?
I would even that it will be more move into or moving away from this all-in-one big IT solutions into leaner solutions and dedicated capabilities that are offered as services or as product factories. I mean, this is something which we intensively work on it, to carve out certain capabilities and offer it not only for us in head office in Vienna, but also to our whole network units. And here the cloud plays, of course, or the hybrid or the private cloud would play a good or would support us from the infrastructure point of view, because you can offer it in one location and deliver it to multiple banks at the same time.
Excellent. Thank you. Shuki, anything to add?
Yeah, so just to what the team mentioned, data analytics and products, AI, machine learning, it's here, it's come, and we are start to see more and more values for the banks. As I mentioned, the infrastructure is here. We have the knowledge, we have the technology, everything can be productized. I bet on that very strong this year. Second one, banking as service, especially embedded finance. The consumer will start to consume financial services at non-financial services. So, it's a great opportunity for banks to be the providers and generate a new revenue stream, and also for the embedders or the distributor on non-financial services to start to make money just by going and promote these kind of services. DeFi, NFTs, crypto, it's coming. We see more and more platforms that are giving access to the traditional banks. We'll see things are coming next year, how to do the bridge between the DeFi and the traditional world. Things around ESG, AI-based climate risk assessment, things around ESG data and centralization, bias and fairness, things that we talked about it as a research last year. I think this year we see that things are getting and productized. And the last things, metaverse and things around Web3. Let's see what the big company will do with that. And I think there will be a lot of opportunity for the financial services to embed some capabilities there.
It's a whole different discussion and very exciting things that are coming. But Ove, in short, what do you see? Anything to add?
I would also add that the platformization of everything, that including banking as a service, but also this buy now, pay later, offering different full-scale platform services and ecosystems. And I think that's something that we haven't seen in Europe and US is a super app yet, that China has a lot of, already several of them, that I think this is something that is yet to come for us.
Yeah, fully agree. So gentlemen, thanks a lot for your time. I think it was really interesting. I hope people found it interesting, but thank you. And I think we're good.
Thank you very much, gentlemen. And if I may say, we look forward to working with Finastra, Raiffeisen and JP Morgan in the future. And well, we are now coming towards the end of day one. How amazing was this first day? And I would love to invite back on stage Bob Rode. Bob.
It was a quite eventful day, huh?
Yeah, you're like all like the stress is falling from his shoulders now. he's getting into relaxation mode. But Bob, we had an amazing day, and I think you've prepared some closing words. You're wrapping the day together, right?
Yeah, absolutely. Yeah,
all
thank you, Felix.
All right.
So hi everyone again. Hope you really enjoyed it as much as we did, hopefully. And we will continue tomorrow with our Intertech event, joined by amazing speakers talking about enterprise AI, customer experience, future of work, and cybersecurity. We'll also have another pitch session with some of the finest enterprise technologies out there. which are applicable throughout all industries. So please have a look at the agenda on the various event pages to tune in again tomorrow. So, and if you have any questions or you would like to reach out to us directly, please send an email to frankfurt@pmptc.com. So thank you to all of the speakers today. Thanks to the audience for tuning in, and thank you, Felix, for moderating everything today.
Thank you for having me. And if you want to join the conversation on Twitter or any social media, PNP Fintech is the hashtag. We'll look into that tomorrow. And as of now, I think we're heading for a beer now, right?
Yeah, that sounds good. Let's
All right. See you tomorrow.
Have a good one, everyone.
Stay safe. Bye-bye.
Bye.